You're walking through a lush forest, surrounded by towering trees that have stood the test of time. As you wander deeper into the woods, you stumble upon a hidden treasure chest. Intrigued, you cautiously open it, and to your amazement, you find a single seed. Curiosity gets the best of you, and you decide to plant that seed in fertile soil. You water it, nurture it, and watch as it transforms into a mighty oak tree. But here's the magical part: as the tree grows, it starts producing more seeds, which you plant and care for diligently. Soon, the forest is filled with these magnificent trees, each one bearing countless seeds. And as they grow, multiply, and reproduce, you realize that you've stumbled upon the secret to untold wealth and success. Welcome to the world of financial compounding, where you are going to learn and discover the astonishing power of compounding, how it can turn your small investments into a financial empire, and the secrets to unlocking its full potential. Before we set off on our compounding adventure, let's first grasp the fundamentals of this incredible concept. Compounding, simply put, is the art of reinvesting your investment earnings to generate even more returns. It's like a snowball rolling downhill, gaining size and momentum as it gathers more snow. In our case, the snowball is your initial investment, and the snow it accumulates is the additional returns it generates. To fully grasp the power of compounding, we need to delve into the concept of compound interest. We'll break down this concept into bite-sized pieces to help you understand the mechanics behind it. You'll see how compounding takes your money to new heights by earning interest not only on your original investment but also on the interest it earns over time. This compounding effect allows your money to grow exponentially over time. Now, let's talk about the magic ingredients that supercharge compounding: time and consistency. Time is your best friend in the world of compounding. The longer you let your investments grow, the more significant the impact of compounding becomes. And you don't need a fortune to get started. Even if you can only afford to invest a small amount initially, consistent contributions over time can yield remarkable results. You might be thinking, but I don't have a huge amount of money to invest right now, or isn't compounding only for the big shots with lots of money? Compounding is not limited to those with large sums of money. It works wonders for anyone, regardless of the initial investment amount. In fact, one of its most magical aspects is its ability to transform even small, regular investments into substantial wealth. Through the power of compounding, your small investments can grow into a significant financial nest egg. It's like planting a tiny seed that grows into a mighty tree, providing ample shade and bearing abundant fruits. In a few minutes, we are going to explore a few investment assets that have created so many rich people, and that you can also start to enrich yourself and put the power of compounding to work. These assets provide opportunities for regular contributions, reinvesting your earnings, and magnifying the growth potential. Now that you've seen how compounding can work its magic even with small investments and understand the fundamentals of compounding, let's dive into how you can maximize its potential to accelerate your wealth-building journey, and some of the best investment options that offer higher growth potential, and how to leverage compounding in these asset classes. 1. Stocks. Investing in the stock market is one of the most popular ways to harness the power of compounding. When you purchase shares of a company's stock, you become a partial owner, and as the company grows and generates profits, your investment can multiply over time. To make the most of stock market investing, focus on well-established companies with strong fundamentals and a history of steady growth. Look for companies with competitive advantages, solid management teams, and a track record of consistent earnings. These factors can contribute to long-term stock appreciation, providing the foundation for compounding returns. 2. Real estate. Real estate can be another powerful avenue for compounding your wealth. Investing in properties allows you to benefit from both rental income and property value appreciation. When you own real estate, tenants pay you rent, providing a steady stream of income. By reinvesting this rental income back into your properties or using it to acquire additional properties, you create a compounding effect that expands your real estate portfolio and increases your cash flow. Furthermore, real estate properties tend to appreciate over time, especially in growing markets. The increase in property value adds another layer of compounding to your overall returns. Remember, the key to successful real estate investing is careful research and choosing properties with strong potential for rental income and appreciation. 3. High-yield savings. While stocks and real estate offer higher growth potential, high-yield savings accounts shouldn't be overlooked. These accounts, typically offered by online banks, pay higher interest rates than traditional savings accounts. Though the interest rates may not match the growth potential of stocks and real estate, high-yield savings accounts serve as a secure and liquid option for your emergency fund or short-term savings. The interest earned compounds over time, making it a practical choice for preserving your capital while earning modest returns. To further supercharge your compounding efforts, the following 3 strategies are usually implemented by most successful investors. 1. Dividend reinvestment plans, DRIPs. When a company pays dividends to its shareholders, you have the option to receive those dividends in cash or reinvest them to buy additional shares of the company's stock automatically. DRIPs enable you to compound your dividends over time, resulting in an ever-increasing number of shares. As you own more shares, the dividends you receive also grow, leading to a compounding effect that can significantly boost your total returns. Many companies offer DRIPs directly to their shareholders, making it an accessible and straightforward way to benefit from compounding. 2. Dollar cost averaging, DCA. DCA involves investing a fixed amount of money at regular intervals, regardless of the market's fluctuations. When prices are low, your fixed investment buys more shares, and when prices are high, you buy fewer shares. The beauty of DCA is that it eliminates the need to time the market, which can be challenging even for seasoned investors. By consistently investing over time, you reduce the impact of short-term market volatility and take advantage of different price points. This strategy is particularly suitable for those who prefer a disciplined approach to investing and want to reduce the psychological stress associated with trying to time the market. 3. Rule 72. The Rule of 72 is a handy mental calculation to estimate the time it takes for an investment to double in value at a fixed annual rate of return. To apply the rule, divide 72 by the annual rate of return. The result is an approximation of the number of years it will take for your investment to double. For example, if you expect an 8% annual return, dividing 72 by 8 gives you 9. This means your investment will double approximately every 9 years at an 8% annual return. The Rule of 72 provides a quick and straightforward way to understand the power of compounding and the potential growth of your investments over time. The time value of money is a fundamental principle in finance that recognizes the fact that money today is worth more than the same amount in the future. This is because money has the potential to grow and earn returns over time. When you invest your money, you're essentially giving it the opportunity to work for you and generate more wealth. If there's one crucial lesson to take away from this video today, it's the immense advantage of starting your investment journey early. Time is the most valuable asset when it comes to compounding. The earlier you start investing, the more time your money has to grow, and the greater the impact of compounding becomes. It's like having a secret weapon in your financial arsenal. Imagine you start investing $1,000 at the age of 25, and it grows at an average annual rate of 8%. By the time you reach 65, that initial $1,000 investment could have grown to over $21,000. On the other hand, if you delay investing until the age of 35, even if you invest $5,000, it would only grow to around $11,500 by the age of 65, assuming the same 8% annual return. This example illustrates the immense advantage of starting early. The earlier you begin investing, the more time your money has to compound and grow. The longer your investments have to work their magic, the greater the impact becomes. To explore compounding, the concept of compounding frequency is crucial to know and understand. Most investments compound on a regular basis, whether it's daily, monthly, or annually. The more frequently your investment compounds, the faster it grows. For instance, let's compare two investments with the same initial amount and annual interest rate, but different compounding frequencies. Investment A compounds annually, while investment B compounds monthly. Even though both investments have the same interest rate, investment B will generate slightly higher returns because it compounds more frequently. Another critical aspect of the time value of money is inflation. Inflation erodes the purchasing power of money over time. A dollar today will not have the same value in the future due to the rising cost of living as we are seeing happening now with the recession. However, by investing and allowing your money to compound, you have a better chance of outpacing inflation and preserving the value of your wealth. Now that you understand the power of compounding and how it can transform your financial future, it's time to focus on how to make it a reality. Discipline and consistency are the key ingredients that will propel you towards financial success. To fully harness the power of compounding, you must cultivate the habits and mindset of successful investors. These habits not only help you stay disciplined but also shape your mindset and guide your decision-making process. Some practical tips and strategies that can keep you on track throughout your investment journey are: 1. Adopt a successful wealthy people mindset. Successful and wealthy individuals possess certain mindsets that contribute to their financial achievements. They have a long-term perspective, focus on creating multiple streams of income, and embrace calculated risks. They understand that wealth is built gradually over time and are willing to delay gratification for future gains. Embracing this mindset and cultivating a positive wealth-building mindset will enable you to align with your goals. 2. Automate your savings and investments. Automation is a powerful tool that can help you stay disciplined and consistent with your savings and investments. Set up automatic transfers from your paycheck to your investment accounts or savings accounts. This ensures that a portion of your income is consistently allocated towards building wealth, eliminating the temptation to spend it impulsively. By automating your financial actions, you create a habit of saving and investing without having to rely on willpower alone. 3. Set clear, achievable financial goals. Having clear and specific financial goals provides a roadmap for your investment journey. Define your short-term and long-term financial objectives, such as saving for retirement, buying a house, or starting a business. Break down these goals into actionable and reasonable steps and set measurable targets that align with your finances. This clarity and focus will keep you motivated and committed to your investment plan, ensuring you stay disciplined over time. 4. Create and stick to a budget. A budget is a powerful tool for managing your finances and staying disciplined. Track your income and expenses, prioritize saving and investing, and avoid unnecessary expenditures. This means you need to understand your financial statement. By knowing where your money is going, you can make informed decisions and allocate your resources effectively. A budget acts as a guiding principle, helping you stay on track and avoid financial setbacks that can derail your investment progress. 5. Educate yourself and stay informed. Continuing your financial education is crucial for making informed investment decisions and staying disciplined. Stay updated on market trends, economic news, and investment strategies. Read books, attend seminars, and follow reputable financial resources to expand your knowledge. The more informed you are, the better equipped you'll be to navigate the investment landscape and avoid impulsive, emotionally driven decisions. 6. Diversify your investments. Diversification is a key strategy for managing risk and staying disciplined. Spread your investments across different asset classes, industries, and geographic regions. This diversification helps mitigate the impact of any single investment's performance on your overall portfolio. By avoiding excessive concentration in one area, you maintain a balanced approach and reduce the temptation to make emotional investment decisions based on short-term fluctuations. 7. Seek professional guidance. Consider seeking guidance from a financial advisor or investment professional. They can provide expert advice, help you create a personalized investment plan, and offer objective insights. Working with a professional can instill discipline in your investment approach, ensuring that you stick to your long-term goals and resist the temptation to deviate from your plan based on market volatility or external influences. 8. Practice emotional discipline. One of the biggest challenges in investing is managing emotions. Fear and greed can lead to impulsive decisions that undermine your long-term goals. Practice emotional discipline by avoiding knee-jerk reactions to market fluctuations and staying focused on your investment plan. Implementing a systematic approach, such as dollar-cost averaging or rebalancing your portfolio periodically, can help you maintain discipline and avoid emotional decision-making. By understanding the principles and strategies behind compounding, you are now well equipped with a powerful tool to build wealth and achieve financial success. It's time for you to take action. Start your compounding journey today, no matter how small your initial investment may be. Don't forget to hit that like button, subscribe to our channel, and share your thoughts in the comments below. Together, we'll create a thriving community dedicated to achieving financial freedom through the magic of compounding. So, keep those notifications on, and let's embark on this thrilling financial adventure together.
Compounding is the ultimate wealth builder, the quiet force that turns small, consistent efforts into massive results over time. But here's the deal. Most people only think of compounding in terms of money. While that's a huge part of it, compounding applies to so many areas of life. If you learn to harness its power, it can transform your finances, skills, relationships, and overall success. So let's break down 12 compounding strategies you must know that will help you double your money. These are practical, actionable steps that can set you on the path to exponential growth. 1. Start investing early. The earlier you start, the more time compounding has to work its magic. Time is the single most important factor in compounding because it's what allows your money to grow exponentially. Let's say you invest $5,000 annually starting at age 25 with an average return of 8% per year. By the time you're 65, you'd have over $1.3 million. Now, if you wait until age 35 to start, even with the same annual investment and return, you'd end up with only around $600,000. That's nearly half the amount, just because you delayed by 10 years. Starting early doesn't mean you need to start big. Even small, consistent contributions add up over time because the key is to take advantage of your greatest ally, time. 2. Reinvest your earnings. Whether it's dividends, interest, or capital gains, reinvesting your earnings is like giving your money a growth hormone. Instead of taking out the returns, let them stay invested. For example, if you're investing in dividend-paying stocks, dividends are your friend, as companies will pay you a portion of their profits for just holding the company's stock as you are an investor. So, if you own dividend-paying stocks, opt for a dividend reinvestment plan. DRIP. This means your dividends automatically buy more shares, which then generate even more dividends. Over time, this creates a snowball effect where your wealth grows faster and faster. Also, reinvestment applies to more than just stocks. Think about real estate. If you're reinvesting rental income into buying additional properties, you're amplifying your wealth-building potential. 3. Focus on skill compounding. Learning isn't just about adding knowledge. It's about multiplying opportunities. When you build a new skill, it doesn't just stand alone. It often complements what you already know, making you more effective in everything you do. For example, if you're a graphic designer and you learn coding, you've just doubled your career opportunities. Or if you're an entrepreneur and you develop public speaking skills, you've amplified your ability to pitch ideas and lead teams. The combination of skills creates a unique value proposition that's hard to compete with. Invest time and resources into learning, whether it's through books, online courses, or mentorship. The earlier you start compounding your skills, the more exponential your growth will be. 4. Focus on high-yield opportunities. Not all opportunities are created equal. Some investments, whether of time, money, or energy, offer higher returns than others. For example, a well-diversified stock portfolio might grow faster than a low-interest savings account. Similarly, learning a high-demand skill like coding or public speaking can pay off far more than a less versatile skill. The trick is to identify areas where your effort or resources will yield the highest returns. Spend your time and money where they'll multiply, not just add, to your growth. 5. Leverage compound habits. Small habits might seem insignificant at the moment, but over time, their effects can be monumental. This is the essence of habit compounding: consistent, incremental actions that stack up to create massive results. For instance, saving $10 a day might not feel impactful right now, but over 30 years at a 7% annual return, it adds up to nearly $370,000. Similarly, exercising for 20 minutes 3 times a week won't transform your body overnight, but over months and years, it can lead to significant health improvements. The key is consistency. Whether it's saving, learning, or improving your health, small, steady efforts lead to big outcomes over time. 6. Increase your contributions. Over time, if you want to double your money faster, you need to increase your contributions over time. When you get a raise or have more money to invest, don't just let it sit in your checking account. Put it to work. Increasing the amount you invest ensures that you're adding more fuel to the compounding fire. The earlier you start increasing your contributions, the faster your investments will grow. It's all about taking control of your income and making your money work harder for you. 7. Build and nurture relationships. Relationships have a compounding effect. When you invest time and energy into building connections, those relationships often open doors to new opportunities, collaborations, and networks. For example, helping someone today might lead to a referral, partnership, or mentorship years down the line. The trust and goodwill you build grow over time, often in ways you can't foresee. Focus on providing value and being consistent. Over time, your network becomes a powerful resource that can accelerate your personal and professional growth. 8. Take advantage of tax advantage accounts. Taxes can eat into your investment returns, but tax advantage accounts like 401k, IRAs, and HSAs help you keep more of your money working for you. By deferring taxes or growing your investments tax-free, these accounts supercharge the power of compounding. For example, if you invest $6,000 annually in a Roth IRA for 30 years with a 7% return, you'll end up with nearly $600,000. And here's the best part: all that money is tax-free when you withdraw it in retirement. That's the power of combining compounding with tax efficiency. Make it a priority to max out your contributions to these accounts. They're one of the easiest ways to boost your long-term returns. 9. Diversify strategically. Compounding works best when you're not constantly losing money. Diversification helps protect your investments from significant losses, ensuring that your wealth continues to grow steadily over time. Think of it this way: if one investment underperforms, others in your portfolio can offset the loss. This minimizes risk and keeps your compounding engine running smoothly. Diversification doesn't mean spreading yourself thin. It means being strategic, investing across asset classes like stocks, bonds, real estate, and even digital assets. The goal is to balance growth potential with stability. 10. Automate your investments. Automation takes the guesswork out of investing and ensures you stay consistent, which is critical for compounding to work. By setting up automatic contributions to your investment accounts, you're removing the temptation to skip or delay investing. This strategy is especially powerful with dollar-cost averaging. When you invest a fixed amount regularly, you're buying more shares when prices are low and fewer when they're high. Over time, this approach helps smooth out market volatility and maximizes your long-term returns. Set it and forget it. Automation ensures you stay on track and allows compounding to do its thing. 11. Track and optimize your progress. What gets measured gets managed. Tracking your progress allows you to see the power of compounding in action and make adjustments as needed. For example, regularly reviewing your investments helps you ensure they're aligned with your goals. If one area of your portfolio isn't performing, you can rebalance to maintain growth. Similarly, tracking your savings rate and expenses helps you find ways to save more and invest more, accelerating the compounding process. Use tools, apps, or even a simple spreadsheet to monitor your financial progress. The insights you gain will help you make smarter decisions and stay motivated. 12. Adopt a long-term mindset. Compounding is a marathon, not a sprint. It rewards patience and discipline, but it can be frustrating in the early stages when growth feels slow. The key is to stay focused on the long-term rewards. For example, in the first few years of investing, your returns might feel insignificant. But as the years go by, the growth becomes exponential. This is where most people give up, right before the compounding effect takes off. Adopting a long-term mindset means resisting the urge to chase short-term gains or time the market. Instead, stay consistent, stay invested, and trust the process. Over time, the results will speak for themselves. For a bonus, be patient and let time do its thing. At the end of the day, patience is the most important ingredient in compounding. You can use all the strategies in the world, but if you don't let time pass, your money won't have the opportunity to compound effectively. If you're in this for the long haul, stay consistent, reinvest your profits, and allow compounding to work its magic. The longer you wait, the bigger your wealth will grow. When you think about building wealth, it's easy to feel overwhelmed. The stock market seems like a roller coaster. Investments look complicated, and sometimes it feels like the rich get richer while you're stuck watching from the sidelines. But there's one secret weapon everyone can use, and it doesn't require a fortune to start, and that weapon is compounding. Compounding is the simple idea that your money, once invested, doesn't just sit there. It grows, and then the growth itself grows, like a snowball rolling down a hill, picking up size and speed. Each of the 40 laws we'll discuss is a building block to unlock compounding power, and each one is rooted not only in finance but also in human behavior, how emotions, habits, and mindsets shape your financial reality. 1. Time is your best friend. The single most powerful advantage you can give your investments is time. Starting early gives your money the longest runway to grow exponentially. The difference between starting at 25 versus 35 or 45 is staggering, not just in numbers but in the financial security you'll gain. Starting early is about planting a seed and allowing it to grow for years, even decades. Every dollar invested today has the potential to double, triple, or multiply many times over if you give it enough time. Time fuels compounding because the returns you earn generate their own returns, building a momentum that is unstoppable. The emotional impact of starting late is more than just financial loss. It's the stress and pressure of playing catch-up. You might feel anxiety as you watch peers build their wealth while you struggle to get started. This feeling can be paralyzing, but it doesn't have to be. Starting early means fewer sleepless nights, less financial worry, and more freedom to take calculated risks. The earlier you start, the less you need to save each month to reach your goals, which means more room for life's joys, travel, family, hobbies, without financial strain. This law is a call to action. Don't wait for the perfect moment because it doesn't exist. The moment you start, no matter how small the investment, you are giving your future self a gift that compounds beyond money. it gives opportunity. 2. Small steps win the race. Many people believe that building wealth requires grand gestures, big paychecks, huge lump sum investments, or dramatic financial moves. The truth is far more encouraging. Consistent small investments over time create the real magic of compounding. Consistency is the engine that drives your investment growth. Even if you can only put aside a little each week or month, showing up regularly and investing that amount adds up and then compounds. Missing a single month might seem small in the moment, but over years those gaps can mean tens of thousands of dollars lost in growth. It's tempting to stop when life gets busy or when you feel like you're not making progress fast enough. But investing consistently builds not just money, but also habits and confidence. Each small deposit is a vote of trust in your future self, a reminder that you value what's to come. 3. Let every cent work hard. The real power of compounding kicks in when you reinvest every single penny of the earnings your investments generate. Dividends, interest, and capital gains don't treat these as extra money to spend or withdraw. Instead, put them right back into your investment portfolio to work for you. This habit multiplies your growth because those earnings themselves start generating earnings. It's tough to resist the temptation to spend money that feels free. When dividends hit your account or your stocks pay out, it feels like a small bonus, a reward for your patience and risk. But if you choose to spend those rewards, you're effectively stopping your snowball from growing. 4. Patience is more than a virtue. It's a strategy. Patience isn't just a nice-to-have quality in investing. It's the cornerstone of successful compounding. The market fluctuates daily, and it's easy to get swept away by fear or excitement. But true wealth comes from holding steady through storms and trusting the slow, steady growth that compounding offers. Patience tests your confidence and commitment. You might feel anxious during market downturns or frustrated when your portfolio seems stagnant. But reacting impulsively, selling in panic, or chasing hot trends often leads to losses or missed opportunities. The emotional roller coaster is real, and only those who master patience find growth. This law teaches that the greatest investment returns don't come from quick wins, but from steady, incremental gains over years or decades. By being patient, you allow your money to grow unhindered by distractions or mistakes. 5. Protect your growth. Investing with your emotions is like trying to drive a car blindfolded. Fear and greed are the two biggest pitfalls that can derail your compounding journey. When the market dips, fear tempts you to sell everything to avoid losses. When prices soar, greed pushes you to buy impulsively at the peak. Both reactions damage your long-term growth. It's easy to get caught in these traps because our brains are wired to react strongly to risk and reward. Watching your investments fall can feel like personal failure. Watching others get rich fast can stir jealousy or impatience. But emotional investing turns a disciplined plan into a roller coaster of erratic decisions, each chipping away at your future security. Avoiding emotional investing means building a mental fortress, understanding that market ups and downs are normal and expected. It means sticking to your plan no matter what headlines scream. This discipline protects not just your money but your confidence. 6. Knowledge reduces fear. There's a unique kind of fear that comes from the unknown. When you don't truly understand what you've put your money into, whether it's a stock, a mutual fund, a real estate property, or a cryptocurrency, every dip feels like danger. But when you take the time to understand your investment, that fear fades. Knowledge doesn't just increase your confidence, it stabilizes your emotional response. Too many people invest blindly, following trends, headlines, or tips from someone on the internet. And when things go south, as they sometimes will, panic sets in. But when you understand the fundamentals behind your investment, you see market dips not as disasters but as discounts. Learning what you're invested in doesn't mean you need to be a finance expert. It means knowing what drives value in your assets, what risks you're taking, and what your long-term strategy looks like. Knowledge is your anchor. It turns anxiety into action and hesitation into confidence. And with that foundation, compounding isn't just something you hope will work, it's something you know will. 7. Let losses teach you. No investor escapes without scars. At some point, your portfolio will dip. You'll lose money, maybe even more than you thought possible. But here's the difference between those who grow wealthy and those who give up. The wealthy treat losses as lessons, not as reasons to quit. A loss cuts deep. It feels personal. It makes you question your decisions, your intelligence, even your future. But in reality, every investor, even the most successful ones, has lost money. What sets them apart is how they respond. A loss is your most valuable teacher. It shows you where your strategy might have flaws, where your emotions took over, or where you placed too much risk. Instead of being ashamed, lean into those lessons. Write them down. Adjust. Grow. The pain of a loss, if harnessed correctly, becomes the wisdom that guides your future decisions. Think of it like going to the gym. No muscle grows without a little tearing first. Losses strengthen your investing muscle, not weaken it. Let them build your resilience, sharpen your judgment, and deepen your patience. If you can learn from every loss, you'll eventually win more than you lose. And that's how compounding continues, by staying in the game long enough for your wins to overtake your setbacks. 8. Don't put all eggs in one basket. Diversification is the emotional insurance policy for your investments. It's not just about spreading your money around randomly. It's about building a financial ecosystem where different types of assets balance each other out so that no single loss can destroy your growth. If all your money is in one stock, one business, or one sector, your financial future becomes a house of cards. One bad earnings call, one regulation change, one market panic, and everything can collapse. That kind of risk creates stress, fear, and impulsive decisions. Smart diversification, on the other hand, builds confidence. When you invest across industries, asset classes, or geographies, you reduce the emotional swings of your portfolio. If one area is down, another might be up, helping you stay balanced and rational. But there's a catch. Diversification should be intentional. Too much, and you dilute your returns. Too little, and you increase your risk. Diversification gives you breathing room. You're no longer waking up every day worrying about the fate of one company or coin. You've built a portfolio that can weather storms, and that emotional stability is what allows compounding to flourish over time. 9. Time in the market is greater than timing it. Trying to time the market, buying low and selling high at exactly the right moments, is one of the most tempting traps in all of investing. It feels like the smart thing to do. Who wouldn't want to jump out right before a crash and back in right before a rally? But the truth is this: almost no one can do it consistently, not even the professionals. Timing the market preys on our desire for control. We want to outsmart the system, beat the odds, and feel like geniuses. But the market doesn't work that way. It's unpredictable, irrational, and driven by factors far beyond anyone's understanding: war, elections, fear, greed, and even rumors. Here's the problem. When you try to time the market, you usually miss the best days, and those best days often make up the bulk of your gains. 1 or 2 missed days a year can cut your returns in half. Suddenly, your compounding journey is off track, not because the market failed, but because you jumped in and out at the wrong times. Staying invested, even when the market looks shaky, gives your money the time it needs to ride out volatility and continue growing. Time in the market allows compound interest to work without interruption. 10. Beware of fees. They eat your returns. There's a silent thief stealing your wealth, and most people don't even realize it's there. It's not the market, it's not inflation, it's fees. At first glance, 1% doesn't sound like a lot, but over 30 years, that 1% could mean the difference between retiring comfortably and falling short. If your portfolio earns 7% annually, but you're paying 2% in fees, you're not earning 7%, you're earning 5%. That gap may not be felt in a week or a month, but over decades, it's devastating. Emotionally, this law hits hard because we trust the system. We think professional management or fancy financial products are worth their weight in gold. But the truth is, many fees are cleverly hidden. They come in the form of management fees, advisory charges, fund expense ratios, and trading commissions. And they all nibble away at your growth, day after day, year after year. Compound interest is powerful, but so is compound loss from fees. Over time, that erosion adds up. The very wealth you're working so hard to build is slowly being siphoned off by someone else. That realization should make your blood boil because it's preventable. Be intentional, ask questions, and understand the fee structure. Because every percentage point you save on fees is a percentage point that goes back into growing your future, not someone else's paycheck. 11. Every dollar counts. There's a fundamental truth in wealth building that few people internalize. You don't just grow your money by earning more, you grow it by keeping more. And the way you do that is by minimizing unnecessary costs. Whether it's high-fee advisors, overpriced actively managed funds, frequent trading costs, or even just lifestyle inflation, these small leaks in your financial bucket slowly drain your potential. $1 here, $50 there, it doesn't seem like much, but those little costs have a compounding effect of their own, only in reverse. When you keep costs low, you protect your base. You give compound interest a clean, strong foundation to build on. That's not just smart investing, it's emotional freedom. You're no longer playing defense. You're playing offense with every dollar you keep. Every cost you cut, every dollar you keep working, adds fuel to the fire of compounding. That's how the wealthy stay wealthy. They respect the value of money, even the small amounts. It's about making sure your hard-earned money is going toward your future, not funding someone else's profit. 12. Keep more of what you earn. One of the most powerful and overlooked forces in compounding is tax efficiency. You can have the perfect strategy, the right investments, and all the patience in the world, but if you ignore taxes, you're leaving massive amounts of money on the table. Every time you pay taxes on gains, dividends, or income, your compounding engine slows down. That's not just lost money today, it's lost future growth on that money. And it adds up faster than most people realize. This law hits a nerve because taxes feel inevitable. And while we can't avoid them entirely, we can reduce them legally and strategically. Tools like tax-deferred accounts, 401k IRA, tax-free growth vehicles, Roth IRA, HSA, and tax-efficient investing, index funds, ETFs, give you the power to let your money grow faster and freer. Think of tax-advantaged accounts as a greenhouse for your investments. Inside, your money compounds in peace, protected from the harsh winds of taxes. And the longer it stays in that greenhouse, the more fruitful your harvest. Tax planning isn't just for the rich. It's for anyone who wants to accelerate their compounding. The less you pay the IRS, the more you keep working for you. Master this law, and you'll feel the emotional confidence that comes from taking full control of your future. 13. Remove willpower from the equation. Discipline is the secret ingredient to compounding wealth. But here's the catch. Discipline is unreliable when it depends on willpower. Emotions, distractions, and life get in the way. That's why automation is your best friend. When you automate your investments through automatic transfers, paycheck deductions, or scheduled contributions, you eliminate friction. You make investing a default behavior, not a decision you have to make over and over. That's powerful. Your money is working while you sleep, while you're busy, even while you're doubting yourself. Automation removes hesitation. It bypasses fear. It creates consistency, and consistency is the lifeblood of compounding. You stop worrying about when to invest. You stop overanalyzing and second-guessing. You let the process do the heavy lifting while you focus on living. Over months and years, these automatic contributions snowball into a fortune, one deposit at a time. When investing becomes routine, your relationship with money shifts. You feel more in control, more capable, more optimistic. 14. Compound interest is powerful, but compound growth is even stronger. We've all heard of compound interest, the idea that your money earns money and then that money earns more money and so on. But if you stop at interest alone, you're not tapping into the true magic of compounding. Compound growth isn't just about your bank balance ticking up. It's about your entire ecosystem of wealth expanding over time. Compound growth includes every aspect of your financial life getting better simultaneously, your income increasing, your investments growing, your skill set expanding, your opportunities multiplying. The difference between someone who merely saves and someone who strategically compounds every resource they have. Night and day. When you invest in yourself, learning new skills, networking, and staying curious, your value increases. And as your value increases, so does your earning potential, your investing power, and your financial options. The growth doesn't just add, it multiplies. Compound interest is the start. Compound growth is the engine. It means you're not just surviving, you're evolving. You're layering win after win, not just in dollars, but in experience, relationships, ideas, and confidence. That's how you build a life that wealth can't buy, and wealth that can buy you time. 15. Your why fuels your how. Numbers alone aren't enough to stay committed. If compounding is the engine, then your goals, your why, are the fuel. Without purpose, discipline fades. Without direction, you'll chase noise. That's why clear, emotionally resonant goals are essential. You're not investing just for the sake of having a bigger number in your brokerage account. You're investing for freedom, for your children, for your future peace of mind, for the day you no longer have to trade time for money. Every single dollar you invest is a soldier in service of that dream. When the market drops, when people doubt you, when you feel behind, a strong why keeps you steady. It reminds you that this isn't just about money. It's about ownership of your life. Set vivid goals. Want a house? Retire early? Travel the world? Start your own business? Write it down. Break it down. Make it real. Because the more emotionally connected you are to your vision, the harder it becomes to quit. A goal gives you a compass. It reminds you, this is why I started, and that's what keeps your compounding strategy alive when willpower runs dry. 16. Embrace volatility. It's the price of growth. Volatility isn't a flaw in the system, it is the system. If investing always felt comfortable, it wouldn't pay as well. That discomfort, that fear when markets drop, that roller coaster, that's the fee you pay for being in the game. Most people run when the ride gets bumpy. They sell at the bottom, buy at the top, and wonder why compounding never works for them. But those who embrace volatility, who expect it, prepare for it, even welcome it, they're the ones who truly compound wealth. Volatility isn't the enemy. This law isn't just financial, it's psychological. It forces you to confront your fear of loss. But here's the truth. The greatest growth always lies just beyond that fear. When you stop seeing dips as disasters and start seeing them as discounts, you shift from panic to power. You're no longer a victim of the market. You're a participant in its long-term rewards. Volatility teaches patience, strengthens discipline, and every time you hold steady through a storm, you come out stronger and wealthier on the other side. 17. Ignorance costs you time and money. Ignorance is the most expensive thing you'll ever own. Every mistake you make out of confusion, every opportunity you miss because you didn't understand, has a price tag. And when it comes to compounding wealth, that price is paid in years of lost progress. But the good news, learning compounds just like money. Every book you read, every article you study, every question you ask, it builds. One insight leads to another, and suddenly your decisions improve. Your timing gets better. Your strategy sharpens. You stop making beginner mistakes, and you start playing the long game like a pro. This law is about humility. It's a reminder that no one is born knowing how to build wealth. But anyone can learn. The person who is willing to keep asking, keep exploring, keep studying, that's the person who wins. When you choose to learn, you reclaim power. You stop being intimidated by terms like ETF or capital gains. You start seeing the system not as a threat, but as a tool. And the more you learn, the more confident you become, not just in investing, but in life. 18. Slow growth wins. The get-rich-quick trap is one of the most seductive lies in finance. It whispers promises of fast money, shortcut success, and freedom without sacrifice. But here's the truth. Nothing sustainable is built overnight. When it comes to wealth that lasts, slow growth not only wins, it protects you. Every time you see someone making thousands overnight, remember this. You're watching the highlight reel, not the full game. Most overnight success stories are years in the making. And worse, many of them crash as fast as they rise. The need for speed is an emotional vulnerability. It feeds on desperation, impatience, and comparison. But wealth built fast without understanding or discipline rarely stays. Wealth built slowly on habit, strategy, and consistency that endures. 19. Protect your principal. Every dollar you invest is a seed, but every dollar you spend out of boredom, sadness, comparison, or celebration without restraint, that's a seed you'll never plant. Emotional spending is the silent killer of your future wealth. We don't always spend because we need something. We spend to feel something, to fix loneliness, to match a friend, to reward ourselves after a hard day. But when your money becomes a way to soothe emotions instead of grow value, you start robbing your future for a temporary mood. Your principal, the base money you invest, is sacred. It's your foundation. Every time you dip into it for unnecessary gratification, you slow the power of compounding. The goal isn't to never enjoy life. It's to spend with intention, not impulse. It asks you to pause before a purchase and ask, is this serving the life I'm building or just the feeling I'm chasing right now? That one moment of clarity can save you thousands and, more importantly, years of lost growth. 20. Control your ego. Ego wants to win. Ego wants to be right. Ego wants to time the market, pick the best stock, beat the crowd, and say, I told you so. But ego is expensive. It trades consistency for glory and discipline for pride. And the market? It humbles egos every day. Humility, on the other hand, compounds like magic. It says, I don't need to be the smartest. I just need to be consistent. It says, I won't chase what I don't understand. It reminds you that boring often beats brilliant, and that admitting you don't know everything is the first step to truly learning. This law doesn't just speak to money, it speaks to identity. So many of us attach our self-worth to being right, to winning fast, to outperforming. But wealth isn't a scoreboard, it's a tool. And when you let go of ego, you gain the freedom to grow without shame, to lose without panic, and to keep going without burnout. You don't need to be the hero. You just need to be present, patient, and teachable. That's how humility makes you rich, not just in dollars, but in wisdom. 21. Influence shapes success. Your environment is everything. You can have the best strategy, the strongest goals, the smartest plan, but if you're surrounded by people who mock long-term investing, who brag about flashy spending, who live for the next paycheck, you'll start drifting too. We become who we're around. This law is simple but profound. Your circle shapes your ceiling. When you're around people who think about legacy, who talk about wealth, who make investing a habit, it normalizes growth. It turns discipline into culture. It makes the journey less lonely and more inspiring. You don't need to cut everyone off, but you do need to intentionally curate your influences. Follow those who teach. Spend time with those who build. Talk to those who listen more than they boast. This law reminds you that compounding isn't just a solo mission. It's supported by shared values. When you see others staying consistent, overcoming setbacks, and thinking decades ahead, you rise too. It's not a competition, it's alignment. 22. Markets change, so should you. The only constant in investing is change. Markets shift, industries evolve, and economies cycle through highs and lows. What worked yesterday might not work tomorrow. And the investors who thrive aren't the ones who try to predict every turn. They're the ones who adapt with grace and speed. Adaptation is not weakness, it's strength. It means you're awake, aware, and agile enough to pivot when the environment demands it. Some investors cling to strategies that no longer serve them simply because they once worked. But nostalgia has no place in financial growth. This law speaks to letting go of your comfort zone. It asks you to release attachment to your past successes, to stop defining yourself by what used to work, and start seeing flexibility as a superpower. The market only cares about your ability to evolve. To compound wealth in a changing world, you must be willing to change too. 23. Fuel your motivation. Compounding is slow. So slow, in fact, that it often feels like nothing's happening until everything does. That's why celebrating small wins is critical. Because without motivation, you'll quit before the magic kicks in. Did you save your first $1,000? Celebrate it. Hit a 6-month investing streak? Acknowledge it. Hit your monthly contribution target even during a tough month? That's worth a damn high five. These milestones may seem minor, but they're not. They're the proof that your future wealth is being built brick by brick. This law is about validating progress, even when it's invisible to the world. In a society that only claps when you've made it, you must learn to clap for yourself during the climb. If you don't find joy in the journey, you'll chase joy in consumption, and that's how compounding gets derailed. This law teaches you to stay engaged, to remind yourself, I'm doing this, I'm building something. 24. Without risk, there's no reward. Risk is not your enemy. Recklessness is. Risk, when understood, measured and aligned with your goals, is the engine of reward. Without risk, your money stays idle, safe, and stagnant. And stagnation is the opposite of compounding. Calculated risk means doing your homework. It means knowing the downside and choosing it anyway because the potential upside is worth it. It's not about gambling. It's about growth with awareness. A portfolio with zero risk often has zero real potential for long-term wealth. This law is about overcoming fear, not by ignoring it, but by respecting it and acting anyway. The fear of loss, the fear of making a mistake, the fear of not being good enough, these are real. But the cost of never trying is higher than the cost of a few missteps. Every great investor has a history of calculated risks. Every success story includes moments of doubt that were overcome by courage. This law reminds you, without a little discomfort, you'll never stretch. And if you never stretch, you'll never scale. Learn to lean into risk with wisdom, and your rewards will follow. 25. Understand the power of dividend reinvestment. Dividends are the quiet workhorses of wealth. They show up like clockwork, delivering consistent value without noise. But when you reinvest those dividends instead of spending them, you're not just earning, you're compounding in overdrive. Reinvested dividends buy you more shares. Those shares earn more dividends, and those dividends, they buy even more shares. It's a self-feeding loop that grows your investment without you having to lift a finger. It's exponential. It's automatic. And over time, it's breathtaking. Reinvesting dividends means saying no to instant gratification. It means passing on small luxuries today for massive freedom tomorrow. That choice, made again and again, separates the rich from the financially stuck. 26. Never stop even in tough times. The hardest time to invest is often the most important time to keep going. During downturns, when fear is high and headlines scream doom, the instinct to pull back becomes overwhelming. You start to question everything, your strategy, your timing, even your own intelligence. But here's the truth. Wealth isn't built when everything feels safe. It's built when you keep planting seeds during the storm. This law is about courage under pressure. When life gets hard, job loss, economic crashes, and unexpected expenses, investing can feel like a luxury. But stopping the flow of investment is like cutting off oxygen to a growing fire. You don't see the damage immediately, but over time, it's devastating. Those who keep investing in hard times reap the greatest rewards during recovery. Why? Because their money was buying assets at a discount, more shares, more opportunity, more growth for less money. It's like being rewarded for your grit. 27. What gets measured? Gets managed. You can't grow what you don't track. Most people say they want to get rich, but they can't tell you how much they spent last month or how their portfolio performed last quarter. That's like driving to a destination without ever checking a map or fuel gauge. Eventually, you get lost, run out of gas, or both. Tracking isn't about obsession. It's about alignment. When you regularly review your investments, your net worth, your contributions, and your goals, something powerful happens. You start behaving like a builder. You become intentional, not impulsive. And intentional people don't get rich by accident. They do it on purpose. 28. Protect your investment capacity. Every time your income increases, life will tempt you to spend more, a nicer car, a fancier apartment, better clothes, and lavish vacations. That's lifestyle inflation. It feels like success, but it's often the death of wealth. Why? Because the more you spend, the less you invest. And the less you invest, the slower your compounding engine runs. People think their income is the key to wealth. It's not. It's how much you keep and invest that matters. When your income grows, your ego wants to catch up. You want to look like you're winning. But real power is quiet. It's found in the person who makes $150,000 and lives on $60,000, while investing the difference every month. It's found in people who trade approval for freedom. If you don't control your lifestyle will control you. That's how people earning six figures end up living paycheck to paycheck, trapped, stressed, and pretending to be successful. That's a lie. And compounding doesn't work well when your money disappears into the appearance of wealth. The wealthiest people protect their investment capacity like a sacred thing, because it is. It's the gap between what you earn and what you spend that fuels everything. Guard that gap with your life. 29. Failure is a wealth teacher. You're going to mess up. Bad investment choices, missed opportunities, emotional trades, forgotten contributions. It's all part of the game. But the worst mistake is thinking mistakes disqualify you from wealth. They don't. They teach you how to earn it better. Every investor you admire has a history of failures. They've bought the wrong stocks, sold too soon, trusted the wrong advice. But instead of hiding from those experiences, they studied them. They asked, what went wrong? What can I learn? How do I do it better next time? This law is deeply emotional because shame often follows financial failure. We don't just say, I made a bad investment. We say, I'm stupid. I'm not cut out for this. That thinking is poison because it paralyzes your progress. Mistakes are part of your education. They're tuition. When you see them that way, you strip away the shame and replace it with wisdom. That shift changes everything. So don't just move on from your failures. Sit with them, study them, mine them for truth, and then use what you've learned to build a smarter, stronger investment strategy, one that honors your past, fuels your future, and reminds you, growth doesn't require perfection, just reflection. 30. Keep emotions out of selling decisions. The moment you sell in fear, you pay twice, once with money and again with regret. It's easy to stay logical when the market is rising, but when it crashes, the noise becomes unbearable. News outlets scream, recession. Your portfolio bleeds red and your stomach knots. That's when panic whispers, just sell, protect what you have. And many do. But those who do often miss the recovery that follows. Your brain is hardwired for survival, not investing. It wants to avoid pain now, even if it means giving up huge rewards later. That's why panic selling is so common. It's a short-term relief that causes long-term damage. Selling should never be a knee-jerk reaction. It should be a calculated decision based on facts, not feelings. You sell because your goals changed, the fundamentals changed, or the opportunity cost is better elsewhere, not because your gut is scared. 31. Different stages, different needs. You don't invest the same way at 25 as you do at 55. The sooner you understand this, the better. Early on, growth is everything. You have time on your side. You can afford risk, volatility, and even some failure because you're compounding over decades. But as you get older, the game changes. It's no longer about just growing. It's about protecting. This law speaks to life stage alignment. The aggressive investor in their 20s should eventually evolve into the protector in their 50s. Too many people stay stuck in one gear. They either never take risk when they're young or never slow down when they're old. This law is about accepting that seasons change. Your life won't always be in hustle mode. At some point, safety matters more because the consequences are bigger. Retirement isn't about YOLO investing. It's about cash flow, preservation, and sleeping peacefully at night. 32. Compound beyond one source. Relying on a single income source is like building a table with one leg. It can hold you up, but not for long. One job, one salary, one stream of money. That's how most people live. But what happens when that job disappears? What happens when that industry shifts or that paycheck stops? Most people panic. But those with multiple streams? They adjust. This law is about financial resilience. Compounding works best when you can feed it consistently. If your only income dries up, your investments stall, or worse, you're forced to withdraw them. But if you've got a side hustle, a small business, dividend income, rental cash flow, or online revenue, you're never cornered. Emotionally, this law is about freedom and control. When all your income flows from one employer, you're at their mercy. But when money comes from different places, you own your time. You get options. and options are everything. 33. Debt compounds against you. Compound interest works both ways, and when it works against you, it's a financial chainsaw. Most people misunderstand compounding. They think it only applies to savings and stocks. But debt? Debt is the dark side of compounding. Credit card interest at 24% doesn't just hurt, it bleeds your wealth dry. Every month you don't pay it off, it grows faster than your investments do. This law is about survival before success. If your investments are growing at 8%, but your debt is growing at 20%, you're not building wealth. You're digging a hole while trying to climb a mountain. It doesn't matter how strong your arms are if the ground beneath you is crumbling. Debt is emotional. It's tied to shame, secrecy, and stress. It traps people in jobs they hate, lifestyles they can't afford, and futures they can't change. But once you get out of it, the clarity, the power, and the liberation is overwhelming. Some debt can be strategic, like low-interest real estate or business debt. But consumer debt, emotional spending, unpaid credit cards, that's not a strategy, it's sabotage. And you can't compound your investments until you stop compounding your liabilities. 34. Use compounding to fund your freedom. The real reward of compounding isn't just a big number in your account. It's the peace you feel when you wake up and know you're free. Freedom looks different for everyone. For one person, it's retiring early. For another, it's leaving a toxic job. For someone else, it's taking a year off to raise their child without financial fear. And that's the beauty of compound investing. It isn't about showing off. It's about taking control back. This law goes deep into emotional clarity. What does financial freedom actually mean to you? Not what Instagram says, not what society glamorizes, but your real, raw, personal freedom, that thing you wish for when you're stressed, tired, or stuck. Compounding makes that freedom possible because it buys back time, and time is the only true currency. 35. Teach others. Compounding isn't just for your portfolio. It works in knowledge, kindness, and generational impact. Once you understand how powerful compounding is, you have a responsibility, not just to use it for yourself, but to pass it on. Because most people don't learn this. They aren't taught in school. Their parents may have never known. And they walk blindly into debt, into financial anxiety, into decades of working with nothing to show for it. When you teach someone, a friend, a sibling, a child, about investing early, staying disciplined, avoiding traps, and letting their money grow, you give them something that ripples for life. That's legacy. That's wealth multiplied without even spending a dime. Wealth without impact is empty. But when you empower others, when you break generational cycles, when someone you love builds freedom because you showed them how, that's soul-level wealth. The more you teach, the more you reinforce your own knowledge. You build your tribe. You grow your network. 36. Wealth is not a trophy. Money reveals character. When you start to win, stay grounded. There's a dangerous moment that comes after years of disciplined compounding, the moment your wealth becomes visible. You buy the nicer car, the better house, maybe even take that luxury vacation. That's not wrong, but it's risky. The world will praise you for the wrong things, for looking rich, for spending loud, for flexing. But that's when compounding can get hijacked by ego. And ego doesn't compound wealth, it spends it. This law is about perspective. Wealth is not a scoreboard. It's not about proving something to people who wouldn't even help you when you were broke. It's about creating options, security, and peace. 37. Insurance and hedging matter. You worked hard to build it. Now protect it like your future depends on it, because it does. Too many people invest for years, only to lose it all because they didn't think about risk protection. A medical emergency wipes out savings. A fire destroys rental income. A lawsuit eats into retirement. It's not just about compounding wealth, it's about defending it. This law brings the emotional weight of loss prevention. It's not exciting to talk about insurance, asset protection, or hedging, but it's absolutely essential. Because when something bad happens, and it eventually will, the last thing you want is to go back to zero. Smart investors use insurance not out of fear, but out of strategy. They buy umbrella liability policies. They insure their properties properly. They diversify to hedge against economic downturns. They don't panic when the market dips because they've structured their portfolio to absorb shocks. 38. Know when to take profits. Compounding is a long game, but there's a moment when it's time to take some chips off the table, not out of fear, but out of wisdom. There's a dangerous temptation in investing: never selling. You watch your portfolio rise and rise and rise, and suddenly you think it'll never come down. You believe you're a genius. You feel invincible. That's not strategy, that's greed in disguise. Knowing when to take profits is about protecting your growth. It's not about timing the market perfectly. It's about honoring your goals. If your investment has tripled and you're able to fund your child's college education, or buy the home you dreamed of, or retire early, why would you gamble that away for a little more? Greed whispers, just a bit more. But wisdom asks, why are you still in? What was your exit plan? What was the purpose of the profit? Letting your gains ride unchecked can destroy years of hard work in a flash. 39. Review and adjust. Compounding is not set it and forget it. It's set it, watch it, tweak it, and learn. Your life changes, the market changes, the world changes, so should your strategy. A 25-year-old with no kids has a different investment horizon than a 45-year-old with a mortgage and a college-bound teen. Yet many investors lock into a plan and never review it until it's too late. This law is about ownership, not just of your money, but of your outcomes. Review your portfolio quarterly. Rebalance it when needed. Check in on your goals. Are you still on track? Do your investments still align with your values, risk tolerance, and future? You don't just let your future unfold by accident. You stay in the driver's seat. You don't panic, but you don't sleepwalk either. You're awake, alert, and aware. 40. Faith in compounding. Builds empires. This is the hardest law because it demands that you keep showing up, even when nothing seems to be happening. Compounding starts slow, sometimes painfully slow. You invest, you wait, you sacrifice, and the numbers barely budge. You question it all. Is this even worth it? That's the moment most people quit. But that's also the exact moment compounding is beginning to build something massive in the shadows, in the background, deep beneath the surface. This law is about faith, not blind hope, but educated trust. If you understand how compounding works, if you've built a strategy and you're following the principles, you have to believe in the process. You have to keep watering the seed, even when there's no fruit yet. This law taps into grit. It's not about being perfect. It's about being persistent. Because one day, when you least expect it, that tiny curve becomes a steep climb. That modest growth becomes a snowball. And you realize every boring month, every skipped splurge, every patient year was worth it. Empires are not built in explosions. They're built in small, disciplined acts repeated over time. If you're watching this right now, there's one thing I need you to understand. Compounding is the most powerful force in wealth building. It's not a get-rich-quick scheme. It's not some exclusive secret only the wealthy know. It's a system that works for anyone, anywhere, at any income level. Most people underestimate compounding because it feels slow at first. But those who truly grasp its power, they become financially unstoppable, which means attaining financial freedom. And by the end of this, You'll be in that group by knowing compounding secrets that make it work effectively. When people hear compounding, they think about money growing in an account. That's just the tip of the iceberg. Compounding is a universal force. It's working in your life right now, whether you realize it or not. It's either working for you or against you. Think about this. Every tiny action you take, every small decision, every habit, every conversation, it all builds up over time. If you're consistently making good choices, they stack up and snowball into something powerful. But if you're making bad choices, that also compounds, dragging you down. Compounding is happening with or without your permission. The question is, are you using it to get ahead, or is it quietly making your life worse? Most people only think of compounding in terms of money, but the truth is, compounding is a force that shapes every part of life. I recently posted a video on this, so if you haven't watched it, do so as I break down the types of compounding that shape our life. It's not just about making your bank account grow, it's about how small, consistent actions in different areas of your life build up over time, turning into something massive. The most successful people don't just use financial compounding, they leverage it in their knowledge, relationships, habits, and even mindset. Once you start seeing compounding beyond just money, you unlock a whole new level of success. The truth is, compounding doesn't feel exciting in the beginning. In fact, it can feel frustratingly slow. You put in the effort, you make the right moves, and yet nothing seems to happen. You invest money, but your account barely grows. You start working out, but your body looks the same. You build skills, but you still feel like a beginner. This is where most people quit. They assume it's not working because the results aren't instant. But that's the trick of compounding. It's a game of patience, not speed. Think of a snowball rolling down a hill. At first, it's tiny. It barely picks up more snow. But as it keeps rolling, it grows, slowly at first, then faster, then exponentially. That's how compounding works. In the beginning, you won't see the rewards. But the longer you stick with it, the bigger and faster it builds. Warren Buffett made over 99% of his wealth after age 50, not because he suddenly got better at investing, but because time finally unleashed the full power of compounding. If you quit too early, you never reach that explosive phase where all your effort pays off. Compounding is like a fire. It only grows if you give it the right conditions. You can't just throw a spark and expect an instant blaze. You need fuel, oxygen, and time. In the same way, compounding thrives on three core pillars: time, consistency, and reinvestment. If you remove any one of these, the entire process slows down or collapses. The first pillar, time, is non-negotiable. The longer you let compounding work, the bigger the results. The second pillar, consistency, means sticking to the process even when it feels slow. The most successful people don't stop when they get bored, they keep going. And finally, reinvestment is what supercharges the whole thing. Whether it's reinvesting money, knowledge, or effort, the key is putting your gains back in to fuel even greater returns. Master these three pillars, and compounding will take you to levels you never thought possible. Everyone wants to double their money, but most people have no idea how long it will take or what strategy will get them there. The truth is, there's no one-size-fits-all approach. Your timeline, risk tolerance, and financial goals all play a role in the way you double your money. And the key to accelerating your money's growth is understanding the right compounding rule that aligns with your specific situation, your salary, and your goals. Whether you're looking for steady, reliable growth or an aggressive wealth-building strategy, there's a method that fits your path. There are several compounding rules available to double or even triple your money. I do have several of these on this channel that you can choose from. So if you would like to get more insights on them, then feel free to go into my channel and get informed on each of the rules. This will enable you to find one that fits your investment goal of doubling your money. The best compounding rule isn't just the one that sounds the most exciting. It's the one that realistically matches your timeline, effort, and financial strategy. If you want to take full advantage of compounding, you need to put your money in the right places. Not all investments grow at the same rate, and some barely compound at all. The key is finding assets that continuously generate returns, reinvesting those gains, and giving them time to multiply. The earlier you start and the more consistently you invest, the bigger the snowball effect. Some of the best places to maximize compounding include index funds, which offer steady growth and reinvested dividends over time, and dividend stocks, where your earnings create more earnings. Real estate can be a powerful compounding tool through appreciation and rental income, especially when leveraged correctly. If you want the highest upside, building a business can create exponential growth by reinvesting profits. And finally, investing in your skills and knowledge provides lifelong returns, because the more valuable you become, the more money you can make and compound. Compounding is powerful, but it's fragile. The same way small, consistent actions can build wealth, success, and personal growth over time, small mistakes can quietly destroy them. The biggest reason most people never see the full effects of compounding is that they unknowingly sabotage it. If you don't protect your compounding, it won't work, no matter how well you start. Here are the top 5 common compounding destroyers. One of the biggest compounding killers is impatience. People give up too soon because they don't see immediate results. Compounding starts slow, and that's where most people quit. Then there's debt, another silent destroyer, which is compounding working against you instead of for you. It makes interest work against you instead of for you, dragging you backward. Lifestyle creep is another silent, compounding destroyer that keeps people stuck, making you spend more every time you earn more, preventing wealth from growing. Procrastination steals your most valuable asset, time. Every year you wait to start investing, learning, or improving, you lose exponential gains. And finally, lack of reinvestment, whether it's pulling money out of investments too soon, not reinvesting for bigger returns, or not reinvesting knowledge and effort, which stops the momentum of growth before it ever gets big. If you want to get rich through compounding and protect your compounding, you need to avoid these mistakes at all costs. Compounding is happening in your life whether you take control of it or not. The small choices you make today, the habits you build, the money you invest, the relationships you nurture, they're all growing in the background. The question isn't whether compounding is happening. Are they working for you or against you? The secret to getting rich, successful, and ahead of 99% of people isn't about chasing overnight wins. It's about setting up unstoppable systems that grow over time. If you start now, stay consistent, and let time do the heavy lifting, you'll look back years from now, realizing that these small, smart decisions made you wealthier, wiser, and more powerful than you ever thought possible. When people hear the word compounding, their minds often jump to boring math problems, interest rates, or technical finance jargon. But compounding is so much more than that. It's not just a formula or a graph that slopes upward. It's a journey, a psychological battle, and an emotional roller coaster. It's waking up every day to keep doing the small, often unrewarded things that don't seem to matter at the time, but end up building a mountain of success. It's not just about money, it's about discipline, sacrifice, belief, and staying in the game long enough to see your efforts come alive. Most people quit before compounding kicks in, not because they didn't work hard, but because they didn't see results fast enough. They gave up in the phase where they needed to believe the most. And that's why this breakdown of the stages of compounding is essential, because if you know what's coming, you're less likely to give up when the results haven't caught up with your effort yet. Stage 1. The zero phase. Compounding is misunderstood, not because it's complex, but because it works quietly. In a world obsessed with speed and overnight success, compounding doesn't scream, it whispers. And because of that, it's often overlooked, doubted, or abandoned too early. But make no mistake, compounding is the most powerful force in wealth building. And if you learn how to stick with it long enough, it will make you richer than your wildest dreams. The problem: most people never make it past stage one. This is where most people quit. You've started saving, you're investing, you've cut back on unnecessary spending, you've been consistent. Maybe it's been 6 months, maybe it's been 2 years, and yet your investment's barely moving, like watching paint dry. $1,000 becomes $1,050, and it feels like an insult. You're looking at the markets every day, checking your balance, wondering what the hell all the hype is about. This phase is suffocating. You've done everything right, but the rewards feel non-existent. Friends around you are flashing new cars, flying on trips, or buying the things you've sacrificed. Social media doesn't help either. It makes you feel like the only fool playing the long game while everyone else is enjoying their money now. This is the test of faith stage, not in numbers, but in mindset. Compounding, by nature, starts slow. The first few years are meant to frustrate you. They're meant to weed out the impatient. They're meant to see if you deserve the reward at the end. Most people can't handle it, but if you stay consistent, the ground begins to shift. Stage 2. The spark phase. Then, one day, something clicks. You check your investment portfolio and notice the gains are slightly more than what you contributed. You receive your first dividend. A side hustle you started pays you for the first time. Your emergency fund hits a number that makes you breathe easier. These are your first wins, small but significant. This is the phase where the compounding engine starts warming up. It's like the first time you lose a pound after weeks of dieting. It's not much, but it proves that your actions matter. The spark phase is when compounding gives you your first taste of its power. And that taste? It's addictive. This stage is deeply emotional, not because you've made a lot of money, but because you finally feel seen. You start learning more because now it matters more. The effort you put in, the sacrifices you made, the nights you chose to budget instead of spend, they're starting to make sense. You finally believe it's working, and belief changes everything. This stage triggers your internal shift. It's where compounding becomes a habit, where you stop needing to see results every day, where you stop checking the charts constantly. It's not about instant gratification anymore. It's about the process. You're learning to trust time, and for most people, that's a brand new skill. The hardest part of stage 2 is keeping your ego in check. Because just as you start to see progress, you may be tempted to accelerate your lifestyle too soon. You might feel like you deserve to splurge, and while there's nothing wrong with enjoying your money, this is where many people plateau. They think the spark is the peak, but they have no idea what's coming next. Stage 3. The momentum phase. This stage is when your financial snowball starts rolling downhill. Your investments are growing not just from your contributions, but from the returns on your previous gains. Your money is now making money. You're no longer just saving, you're scaling. Maybe you've paid off high-interest debts, maxed out a retirement account, or bought into appreciating assets. This is the momentum phase, and it's exactly what it sounds like. The wind is finally at your back. It feels like you've cracked the code. This stage is euphoric. You go from being the person who doubted compounding to becoming its loudest evangelist. Your friends are still grinding paycheck to paycheck, but you're seeing the other side. You're not rich yet, but you can feel that you're getting closer every day. Your relationship with money is transforming from one of survival to one of strategy, and you start thinking about money differently. This phase is about identity. You stop looking for quick wins and start thinking in decades. You realize how powerful your position is, not because you're lucky, but because you were disciplined during the zero phase. It's the stage that births pride, not in a boastful way, but in the "I built this with my own hands" kind of way. You begin to see yourself differently as your mindset changes. You've tapped into something 99% of people never stick with long enough to experience. However, momentum doesn't mean invincibility. Markets still fluctuate. Life still happens. But the difference is you're prepared now. And you know deep in your soul that the only direction is forward. Stage 4, the snowball phase. This is where the game changes forever. Now, you've crossed a line, and compounding no longer requires you. Your investments and assets now generate more income than your actual job. You're earning money while you sleep, while you rest, while you travel, while you do absolutely nothing. You're financially free or extremely close. You no longer work because you have to. You work because you choose to. This is the phase where compounding becomes unstoppable. Your net worth grows even when you take breaks. Your wealth works harder than you do. At this stage, your money has officially replaced your labor. You've crossed the threshold most people dream about, true financial independence. It's surreal. You remember those early days when you were barely getting by, cutting back on small luxuries, grinding every month just to stay consistent. And now, you're living off the fruits of those decisions. This is where people start asking for your advice because your results are becoming visible. The same people who questioned you now ask for advice. The same friends or family who thought you were crazy now envy your discipline. But what truly hits hardest in this phase is the freedom. You wake up and no longer have to work. You can if you want, but you don't have to. Time becomes your most valuable currency. You're now able to think about legacy, impact, and lifestyle. You can spend more time with your family, travel more, say no more often. You now have power, the kind of power that only comes from financial freedom. Not control over others, but control over your life. And that changes everything. This phase brings peace. It brings the rarest form of success, silent success. You don't need to prove anything to anyone. You know you've won a game that most people never even understood how to play. This is also when gratitude sets in. You reflect on the early phases, the sacrifices, the nights you stayed in, the boring budget meetings, the times you felt like quitting, and you're thankful you didn't. This phase makes every ounce of delayed gratification worth it. It validates your entire journey. Stage 5, the legacy phase. This is the highest form of compounding, the point where your wealth is no longer just for you. It's for generations. Your investments, skills, and knowledge are passed on. You start realizing that your wealth will live longer than you will. Your money, once just a tool to escape paycheck-to-paycheck living, is now a vehicle for impact. Your investments can now fund generations, pay off your grandchildren's tuition fees, and erase your family's debt forever. Your children don't start at zero, they start where you left off, but now with education. This is the legacy phase, and it's not about ego. It's about purpose. You begin to see money not just as security, but as meaning. You think about how far you've come, how you broke generational cycles, how your discipline, your patience, and your decisions created something bigger than you. You've transferred knowledge and instilled principles. You've lived well and left something better behind. This phase changes your view on time, life, and what really matters. Because the money, that's just the outcome. The real reward was who you became to get here. The person who endured stage 1, who trusted through stage 2, who stayed disciplined in stage 3, who tasted freedom in stage 4, and who, now in stage 5, lives not just for self, but for generational, financial freedom. At this stage, you've become the ultimate version of wealth, the quiet, patient, intentional builder. Compounding isn't just a financial principle. It's a life philosophy. Stay in the game long enough, and it will reward you more than you can imagine. Quit too soon, and you'll never know how close you were. So stay the course. Believe in the seed, even when it hasn't broken the soil. Compounding is not a concept you learn once and forget. It is a force of nature, a law of the financial universe, just as gravity is a law of the physical one. It works quietly, invisibly, and relentlessly, whether you choose to take advantage of it or not. The reason so few people become truly wealthy is not because they lack intelligence or opportunity, but because they fail to respect time and the power of small, consistent growth. Everyone wants to skip to the part where the numbers explode, but compounding doesn't reward impatience. It rewards discipline, persistence, and belief. When people think about wealth, they often picture the end result: millions in a bank account, a portfolio generating six-figure dividends, or assets that pay them while they sleep. But the truth is, every fortune begins in the quiet, unnoticed years of compounding, where progress looks painfully small and where most people quit. They plant a seed and expect a tree the next month. When it doesn't happen, they walk away, telling themselves it doesn't work. But those who stay, those who continue watering, those who trust the process, they get to witness the magic that compounds slowly at first, then suddenly, all at once. The reality is, compounding isn't limited to money. It applies to knowledge, relationships, health, habits, and even reputation. The longer you stay consistent, the stronger the results become. What makes it so powerful is not just the math, it's the psychology. It teaches patience in a world addicted to speed, vision in a society obsessed with instant gratification, and faith when progress seems invisible. Understanding compounding isn't just about becoming rich, it's about learning one of life's most important lessons. The big things are built by honoring the small things. Knowing that, this video will take you through the 9 phases of compounding that money, habits, relationships, knowledge, and reputation go through to multiply and flourish. Each phase carries its own struggles, emotions, and victories. Each phase demands something different from you: belief in the beginning, discipline in the middle, and wisdom in the later stages. If you truly want to change your financial destiny and even your life as a whole, you must not only understand compounding with each phase of it, but you must also live it. Phase 1. The planting stage. Every great forest starts with a single seed. In the same way, your compounding journey begins with the planting stage, the moment you take the first step, no matter how small it feels. This stage is about one thing: getting started. Most people never make it past this point because they overthink, wait for the perfect time, or convince themselves they need a large amount to begin. But compounding does not care about size, it only cares about time. A $20 invested today has infinitely more power than $100 invested years later. The seed you plant today is not about what it grows into tomorrow, but about giving it the years it needs to multiply. The planting stage demands courage. It is uncomfortable because the effort feels disproportionate to the reward. You are giving up money, time, or energy, and the return looks insignificant. You save a few $100s, you read for an hour a day, you exercise 3 times a week. Nothing looks different at first. This is where most people fail. They stop watering because the soil still looks empty. But what they do not see is that beneath the surface, foundations are being laid. The soil is doing its work invisibly. Planting small but right is crucial. In money, this means choosing vehicles that align with your goals: low-cost index funds, retirement accounts, or even a simple automated savings plan. In habits, it means focusing on routines you can sustain, not extreme bursts of energy that lead to burnout. The key is not speed, but consistency. Plant a habit of saving every month, no matter how little. Plant a habit of reading every day, even if just 10 pages. Plant a habit of learning skills, investing in yourself, and avoiding debt. These are your seeds, and one day, their roots will run deep. The challenge of the planting stage is faith. You need to believe in growth you cannot yet see. Everyone around you may laugh at your small beginnings. You will doubt yourself and wonder if it's even worth it. But the truth is, the planting stage is where you separate yourself from the masses. The majority never start. They talk, they dream, they procrastinate. You act. That alone places you ahead of most people. And while your progress may be invisible now, one day it will be undeniable. Phase 2. The root stage. After planting comes the root stage, which is the period where your compounding is working, but you cannot yet see the results. It is the most dangerous stage because it tests your patience like nothing else. In this stage, your contributions are small, your growth looks flat, and your sacrifices feel heavier than the rewards. You might save and invest for months, even years, and feel as though nothing is happening. But like a seed pushing roots deep into the soil, the invisible foundation is forming. Roots are not glamorous. Nobody brags about the roots of a tree. They only admire the branches and fruit. But without roots, there is no tree. The same is true for wealth. This stage is about building the habits, systems, and discipline that will protect your future growth. When you automate your savings, stick to your investment plan, and resist emotional decisions during market ups and downs, you are building roots. When you sacrifice a little comfort today for financial security tomorrow, you are building roots. The emotional danger here is quitting too soon. Because growth feels invisible, many people abandon the process. They stop investing because the numbers are too small. They stop saving because it takes forever. They break their habits because they don't see results. But compounding works like a slow burn. It demands silence before the explosion. If you rip the seed out of the soil to check on its progress, you kill it. If you abandon your system too early, you never give compounding the time it needs. Financially, the root stage is where habits matter more than returns. Whether your investments grow by 5% or 10% annually is less important than the fact that you are consistently adding to them. This is also the time to protect yourself from threats, avoid unnecessary debt, resist get-rich-quick schemes, and focus on the long term. The discipline you build now will protect you later when your wealth becomes significant. The beauty of the root stage is that although it feels invisible, it is the most powerful foundation you will ever create. Your habits, mindset, and discipline are your roots. Without them, even if you make money, you will lose it. But with them, your growth becomes inevitable. The question is, can you endure the silence? Can you continue watering when everyone else stops? Those who can graduate to the next stage, where growth finally becomes visible. Phase 3. The sprout stage. The sprout stage is the first time you actually see signs of life. After all the planting, watering, and waiting, something breaks through the soil. It is small, fragile, and unimpressive compared to the tree it will one day become, but it is visible. And that visibility is powerful. It proves that the system works. For many, this is the moment of validation, when their savings account shows a few $100s of interest, when their investments start to generate dividends, or when they realize their habits are finally paying off. The sprout stage is both motivating and dangerous. On one hand, seeing results energizes you. You feel proud, encouraged, and willing to keep going. On the other hand, the returns are still small, so small that if you are not careful, you will become frustrated. For example, an investor who puts aside $200 a month might see only $100 in interest at the end of the year. That $100 feels tiny compared to the sacrifice they made. Some people look at that number and say, "All this for just $100?" And they quit. Others, however, smile at that $100 because they know it is proof of life. They know that if it worked on $200 a month, it will explode with $2,000 or $20,000 a month. What separates success from failure here is perspective. If you measure your results only in short-term numbers, you will feel disappointed. If you measure your results in terms of progress and proof, you will feel unstoppable. The sprout stage is less about financial returns and more about psychological reinforcement. It teaches you that consistency works. It confirms that the soil was fertile, that the roots were worth building, and that growth is not a myth. This stage is also where many people make their first mistakes. They see their money growing and become tempted to spend it. They pull out their investments to buy something flashy, destroying years of progress. Or they start chasing faster returns, jumping from one investment to another, thinking they can outsmart compounding. But a sprout is fragile. Pull it too soon, neglect it, or plant it in too many different soils, and it dies. Patience remains your most important asset. The small returns are not the point, the proof is. And once you see the proof, your only job is to protect it and continue watering. Phase 4. The growth stage. The growth stage is where compounding begins to feel real. The sprouts that once looked small and fragile now start to take shape. The returns you earn are no longer trivial, they are noticeable. You look at your portfolio and see hundreds, maybe thousands of dollars generated in growth. You see your wealth curve moving upward, not just in theory but in reality. This is the stage where many people finally start believing in the process. Momentum is everything in this phase. At first, you were carrying compounding on your back. You were the one saving, contributing, and doing all the heavy lifting. But now, compounding starts to push back. Your money is working for you. It is creating more money. The hours you put into building your habits, the sacrifices you made early, the discipline you showed when results felt invisible, all of it begins to pay off. You are no longer climbing uphill. The slope begins to tilt in your favor. What makes the growth stage so powerful is that it creates a feedback loop. Seeing visible, meaningful results motivates you to keep going. You save more, invest more, or double down on your habits because now you believe. And because you contribute more, your compounding accelerates even further. Success creates confidence, and confidence fuels more success. This is how small beginnings transform into unstoppable momentum. But this stage also brings new challenges. The danger here is complacency. Because your money is growing on its own, you may feel tempted to stop contributing, to coast, or to think you have made it. Some people even take on unnecessary risks, thinking they are invincible because their investments have been growing. Others let lifestyle inflation eat away at their progress, spending more as they earn more, and slowing their compounding curve. The key to thriving in this stage is discipline. Just because the tree is growing does not mean you stop watering it. In fact, this is the time to protect your habits even more fiercely. Automate your contributions, avoid unnecessary debt, reinvest your gains, and resist the temptation to pull money out prematurely. The growth stage is when your system is finally paying you back. Do not sabotage it. Because the next phase, acceleration, is where everything changes. Phase 5, the acceleration stage. The acceleration stage is the tipping point. It is the moment when your wealth curve bends upward in a way that feels almost surreal. Growth is no longer slow, steady, and incremental. It begins to snowball. Your money is making more money than you are. The returns from your portfolio exceed your yearly contributions. The dividends, interest, or appreciation you earn in a single year might equal or surpass what you worked so hard to save in the past. This is the stage where compounding stops feeling like theory and starts feeling like magic. To understand why this happens, consider the rule of 72. This simple rule states that if you divide 72 by your annual rate of return, you will know how long it takes for your money to double. For example, if your investments earn 8% a year, your money doubles every 9 years. At first, those doubles feel small. $1,000 becomes $2,000, then $4,000. But eventually, those doubles explode. $125,000 becomes $250,000, then $500,000, then $1 million. The math does not just grow, it bends, accelerating faster and faster with each cycle. The experience of this stage is thrilling. You look at your statements and feel shocked by how quickly the numbers climb. What once felt impossible now feels inevitable. But with that thrill comes danger. The danger of overconfidence, greed, or arrogance. Many people, upon reaching this stage, begin to think they are smarter than the system. They start timing markets, chasing risky bets, or increasing their spending dramatically because they feel untouchable. This is how fortunes are lost. The truth is, the acceleration stage is where compounding becomes self-sustaining. It no longer needs massive contributions from you, but it still requires protection. Your job now is to safeguard your system, keep reinvesting, avoid emotional decisions, and stay the course even when markets fluctuate. Pulling out your money too soon is like cutting down a tree just as it starts to bear fruit. The acceleration stage rewards those who trust the process, not those who try to outsmart it. This stage is also where financial independence becomes real. Your compounding may now cover your living expenses, allowing you to step back from work, reduce stress, or pursue passions without worrying about survival. For many, this is life-changing, but it is only possible because you endured the earlier stages, the planting, the roots, the invisible growth. This stage is not an accident. It is the inevitable reward of patience. And yet, even here, the journey is not over. What comes next is the explosion stage, when compounding breaks through every ceiling you thought existed. Phase 6. The explosion stage. The explosion stage is where everything changes. For years, compounding felt slow, invisible, and frustrating. Then it became noticeable, and later it started to accelerate. But now, the curve bends so sharply upward that the growth feels unreal. This is the tipping point, the moment when your compounding stops crawling and begins to sprint. The money you once fought to save in small increments now multiplies by itself at breathtaking speed. At this stage, the returns from your portfolio often exceed your annual salary. If you're earning $60,000 a year at your job, your investments may now grow by $70,000, $80,000, or even $100,000 in a single year without you lifting a finger. What once took you years of labor to accumulate is now generated automatically through the power of time and mathematics. This is the stage where you finally grasp why compounding is called the eighth wonder of the world. The explosion stage feels miraculous, but it is not magic. It is math, working consistently over decades. The reason so few people ever reach it is not because it is rare. It's because they quit before arriving. Compounding requires years of patience before it rewards you with exponential growth. People pull out their money too soon, chase quick returns, or give up in frustration. They sacrifice the explosion stage for short-term gratification. But for those who endure, the explosion is both thrilling and dangerous. Thrilling because the wealth you once dreamed of suddenly becomes tangible. Dangerous because the sudden growth can tempt you into reckless decisions. Many people, upon reaching this stage, feel invincible. They start to overspend, take unnecessary risks, or believe that nothing can stop their wealth from growing. This is where discipline matters most. The explosion stage is not a time to relax. It is a time to double down on the systems that got you here. The tipping point is not just about money. It's also about mindset. You realize that you no longer need to fight for every dollar. Compounding has taken over. You are not just financially secure, you are financially powerful. The explosion stage is proof that patience, consistency, and faith were worth it all along. But what comes next is even greater. Freedom. Phase 7. The freedom stage. The freedom stage is the point at which compounding liberates you from the grind. You are no longer trading time for money. Your investments, assets, or systems generate enough to cover your lifestyle. You wake up in the morning and realize that your survival no longer depends on working a job you dislike, reporting to a boss you resent, or sacrificing your health for a paycheck. Your wealth works for you now. This stage is often described as financial independence, but it's more than numbers. It's a psychological transformation. Freedom is the absence of fear. It is the ability to make choices based on desire, not desperation. When compounding covers your bills, you are free to pursue passion projects, explore new ventures, or simply rest without guilt. You can choose work because you love it, not because you need it. That is a level of control over life that very few ever experience. The freedom stage is also where the meaning of wealth begins to shift. In earlier stages, money was about survival, security, and growth. Now, it becomes about purpose. You start asking deeper questions. What do I want my life to stand for? How do I want to use my wealth to shape my legacy? What impact do I want to have on others? Compounding at this point has given you the gift of time and choice. What you do with it defines who you truly are. But freedom also comes with responsibility. If you become careless, lifestyle inflation can eat away at your compounding. If you become reckless, risky investments can undo decades of progress. If you become complacent, your system can stagnate. Freedom requires wisdom. It is not the finish line. It is the gateway to a different kind of journey. The freedom stage is where life stops being about making a living and starts being about designing a life. Compounding is no longer a tool to survive. It is a partner that works silently in the background, ensuring your wealth continues to grow even while you sleep. Phase 8. The legacy stage. The legacy stage is where compounding outlives you. It is the point at which the wealth you've built becomes bigger than your own needs, bigger than your own lifetime. It is no longer about you. It is about impact. Compounding at this stage ensures that your children, your grandchildren, your community, or even causes you believe and benefit from the systems you created. When most people think about legacy, they think about inheritance, a pile of money passed down. But true legacy is not just about handing over wealth. It is about handing over wisdom, systems, and habits that allow that wealth to keep compounding. If you leave millions to your children but fail to teach them the principles of patience, discipline, and long-term thinking, the fortune will vanish. But if you pass down both money and mindset, the compounding continues long after you are gone. The legacy stage also applies beyond finances. As you already know, knowledge compounds, reputation compounds, habits and relationships also compound. Every lesson you teach, every book you write, every seed of wisdom you plant in someone else has the potential to grow exponentially. Think of the ideas of great thinkers, the inventions of innovators, the stories of leaders. They all compound across generations, influencing people who never met them. Your wealth is only one part of your legacy. Your influence is another. The danger in this stage is believing it happens automatically. Legacy must be designed. You must create systems, trusts, wills, businesses, investments that ensure your compounding continues. You must teach your children and those who follow you to value patience, to respect growth, and to resist the temptation of shortcuts. Legacy is intentional, not accidental. The beauty of the legacy stage is that it transforms compounding into something eternal. Long after you are gone, the seeds you planted, the roots you built, the tree you grew continues to bear fruit. Your wealth funds opportunities. Your wisdom shapes decisions. Your influence ripples across time. This is the ultimate reward of compounding, not just financial freedom, but the chance to leave the world better than you found it. Phase 9. The Eternal Stage. The eternal stage is where compounding transcends you. It is the point where the systems you've built, the wealth you've accumulated, and the wisdom you've passed down continue to grow even after you are no longer here. This is the stage where compounding becomes unstoppable, not because of your active contributions anymore, but because of the structures and habits you left behind. At this level, compounding is no longer about doubling money or reaching financial milestones. It becomes about perpetuity, the idea that your efforts ripple across generations and across lives you may never meet. Think of the great fortunes that continue to fund universities, charities, and foundations centuries after their founders have passed. Think of the books, inventions, and philosophies of long-gone thinkers that continue to shape the way the world works. That is eternal compounding in action. Wealth, ideas, or influence that cannot be stopped because it is locked into systems larger than any single human being. The eternal stage requires vision. It is not about handing someone a pile of money. It is about designing vehicles of unstoppable growth, trusts that keep generating income for your family, businesses that live beyond the founder, charitable foundations that grow and fund causes, intellectual work that compounds in value as it's passed from reader to reader, generation to generation. The wealth may start financial, but at this stage it becomes spiritual and cultural. You are no longer compounding dollars, you are compounding destiny. But reaching this stage does not happen by accident. It requires intention. Many people grow wealthy but fail to plan, and their fortunes disappear within a single generation. Studies show that most family wealth is gone within 3 generations because it was not paired with systems or wisdom. The eternal stage is not just about leaving money behind. It is about embedding principles of patience, long-term thinking, and stewardship into those who will carry the torch after you. What makes this stage so extraordinary is the realization that compounding is infinite. While your lifetime is limited, compounding is not. As long as time moves forward, compounding has room to expand. The only question is whether you will structure your wealth, your knowledge, and your influence in such a way that they continue to grow without you. The eternal stage is the highest reward of compounding. It is the transformation of temporary effort into permanent impact. The truth about compounding is that it does not care who you are, where you come from, or what your past looks like. It only cares whether you start and whether you stay consistent. The wealth curve bends in favor of those who plant early, nurture their growth, endure the invisible seasons, and allow time to do its heavy lifting. Everyone faces the same choice: spend life chasing quick wins and instant gratification, or commit to the slow, deliberate, and exponential path that leads to freedom, security, and impact. Compounding is not just a financial principle, it is a life principle, one that rewards patience, discipline, and vision. At the end of the day, the question is not whether compounding works, it always does, but whether you will allow it to work for you or watch it build wealth, freedom, and legacy for someone else. Let's talk real for a second. Most people never build wealth, not because they're lazy or dumb, but because they don't understand one key principle that runs the entire game: compounding. And I'm not just talking about money. I'm talking about habits, skills, reputation, relationships, mindset, everything. See, compounding isn't flashy. It's that quiet grind, day in, day out, that feels like it's doing nothing until one day it's doing everything. The problem is, most people never stick around long enough to see it work. They quit after a few weeks at the gym. They stop investing when the market dips. They bail on their goals when life gets quiet. And that's why they stay stuck. Not because they don't have what it takes, but because they misunderstood how long it takes. Compounding works in levels, and if you don't know what those levels are, you'll keep jumping ship before the explosion ever happens. In this video, I'm breaking down the real layers of compounding, what each one looks like, how it feels, and why most people never move past the early levels. And once you see how it works, you'll stop rushing, stop comparing, and start letting time do what hustle alone can't. Level 1. Linear growth. This is where everyone starts. It's the part no one claps for, the part that feels like nothing is happening, and the part where most people quit. Linear growth is slow, it's steady, it's boring, but it's absolutely necessary. Whether you're putting $50 a month into an investment account, going to the gym for the first few weeks, learning a new skill online, or posting your first content, this level is the silent beginning. You're doing the work, but the results aren't loud yet. You don't feel a payoff. You don't get external validation. It feels like you're grinding in the dark, and you start questioning if any of it even matters. This is the hardest level because our brains are wired for instant feedback. We want to see the reward now. We want the investment to double, the abs to show, and the followers to grow. But linear growth doesn't work like that. You're building a foundation, and foundations are underground. Nobody praises you for laying bricks. They praise you when the house is finished. And that's where most people mess up. They stop watering their seeds just before they sprout. They abandon the habit because it didn't go viral. They walk away from the process because they can't see the progress. What's dangerous about this level is that it feels like a failure when it's actually a test. Linear growth is asking you one thing. Can you stay consistent even when it's quiet? Can you keep investing, keep learning, keep working, even when there's no applause? Because if you can't, then you'll never make it to the next level, where compounding begins to show its power. This level is about developing trust in the process. It's about showing up when nobody's watching. It's about knowing that even if the progress is invisible today, it's still building under the surface. So if you're in this phase right now, grinding, growing, with nothing to show yet, don't stop. This is the seedling stage. The results are coming, but only if you stay planted. Level 2. The first echo. Now this is where things start to get interesting. You've been showing up. You've been putting in the reps, the dollars, the time, and for the first time, you're starting to see a small return. Not huge, but tangible. This is what I call the first echo. It's the moment where the energy you've been putting out starts to echo back. Whether that's a few bucks of interest in your investment account, a noticeable change in your body, your first sale, your first breakthrough moment, this is when the game subtly shifts. And the key word here is subtle. See, most people don't notice this echo because they're so focused on the explosion they were expecting. But this stage is crucial because it confirms that compounding is real. It's no longer just a theory or something you heard online. It's something you feel. The dollars start earning their own dollars. The work you put in starts working for you. And it's not just about growth, it's about momentum. That little spark creates something deep inside of you. Belief. And that belief is everything because belief is what keeps people in the game long enough to win. The trap here, because the growth is still small, some people start underestimating it. They might say, it's only $5, or it's just one new client, or it's just a tiny improvement. And they let the smallness fool them into quitting. But what they don't realize is that this small gain is proof that the system is working. And once that system is working, your only job is to feed it and protect it. Keep showing up, keep reinvesting, keep doubling down on what's working. You've entered the realm where your effort starts to multiply, not just add. And while it may not look like a lot yet, the engine is now alive. This is when you have to fight impatience. Because the compounding effect doesn't care how badly you want quick results. It rewards those who let it breathe, those who stay disciplined, those who see a $5 return and treat it like $1 million sign of progress. This level is about understanding that the first echo isn't the reward. It's the signal that the reward is coming. And if you can recognize that and stay focused, you're already ahead of 90% of people who give up before this moment ever arrives. Level 3. Exponential growth. This is the level where things go from quiet to undeniable. You've been consistent. You've passed through the slow, frustrating grind of linear growth. You've caught that first glimpse of return during the early compounding stage. But now, you've stayed in long enough for the real magic to kick in, exponential growth. This is the point where your graph stops looking like a straight line and starts curving upward. And it's not luck, it's math, discipline, and time finally rewarding you for sticking around when it was still boring. At this level, the growth starts multiplying faster than you ever expected. If we're talking about investing, your returns are now earning returns on their returns. A $10,000 investment that took years to reach $20,000 might jump to $40,000 in just a fraction of that time. If we're talking about business, the clients start rolling in without constant outreach because referrals are compounding. If it's your personal brand, you go from struggling to get noticed to hitting algorithm after algorithm because your audience is now growing on its own. The work you did in the shadows is now working for you. That's the power of exponential growth. But let me be clear, this level doesn't feel like a win at first. It feels like a storm. Things grow fast, and if you're not prepared, it can overwhelm you. The temptation to relax kicks in. You might want to coast. You might think, I've made it. But the most dangerous thing at level 3 is believing that growth will continue without effort. The truth is, exponential growth rewards those who double down, not those who sit back. Now is when you need to pour even more back into the system, more reinvestment, more learning, more refining of your process. Because this window of momentum is precious, and if you treat it carelessly, it can disappear just as fast as it arrived. What's emotionally powerful about this level is that your past self finally feels validated. Every dollar you saved, every video you made, every sacrifice you endured, it all makes sense now. People start noticing, opportunities open up, and yet, deep down, you know they didn't see the struggle. They didn't see the sleepless nights, the second guessing, the moments where quitting felt easier. But you know, and that knowing changes something in you. It gives you not just confidence, but clarity. You realize that compounding isn't just about money or success. It's about the person you had to become to earn it. So if you're starting to feel things accelerate, don't panic, don't get lazy, and don't stop now because this is where the gap widens. Most people never make it here, and those who do often get drunk on their early success and fall off. But the ones who lock in at this level, they build empires, they buy time, they create freedom, because exponential growth is no longer potential, it's reality. You just have to respect it enough to keep it going. Level 4. Compounding income. This is the level where wealth building shifts into an entirely different gear, because now it's not just about one stream of income growing. It's about creating multiple streams that grow, feed each other, and compound together. This is where financial momentum becomes financial multiplication. You're no longer depending on a single paycheck, a single investment, or a single business. You've built systems that generate income while you sleep, while you rest, while you live. And it all started back at level 1, but now the harvest has become a forest. At this point, you've likely got income from different sources. Maybe you've got long-term investments generating returns. Maybe your business or brand is bringing in consistent revenue. Maybe you've started earning from affiliate deals, digital products, rental income, dividends, or even royalties from something you built once and now continues to pay you over time. Whatever it looks like, the key is, these streams are not isolated, they compound together. One stream helps fund the next. Profits from one venture are reinvested into another. And the more streams you create, the more your risk decreases while your freedom increases. But here's what makes this level powerful. For the first time in your life, you feel safe. Not just comfortable, safe. Because you're no longer relying on a job that could lay you off. You're no longer stressing over one client, one launch, or one paycheck. You've built options, and options are power. You can say no to things that don't serve you. You can walk away from toxic environments. You can make decisions from a place of freedom, not fear. That's not just financial peace, that's psychological wealth. And let's be honest, this is where people start asking, how did you do it? But they didn't see the years of consistency, patience, and sacrifice that got you here. They didn't see the compound effect building silently in the background. And now that it's loud, they think it happened overnight. That's why you have to stay grounded, because success can be just as dangerous as failure if you let it get to your head. You need to stay disciplined, keep reinvesting, keep learning, keep diversifying. Because once you understand how powerful multiplying income can be, the game becomes one of stability, longevity, and legacy. This level isn't about being rich, it's about being resilient. If one stream dries up, you're still good. If the market shifts, you've got backups. If life throws you a curveball, you don't crumble, you adapt. That's the real power of level 4. You've engineered your life to survive storms and thrive in seasons. And most importantly, you've bought yourself time. Time to build, time to rest, time to live life on your terms. That's what compounding income unlocks, and once you taste it, you'll never go back to living paycheck to paycheck again. Level 5. The Roar. This level changes everything, not just financially, but socially, professionally, and personally. Because now, it's not just your money that's compounding, it's your reputation, the name you've been quietly building, the consistency you've shown, the trust you've earned, that silent whisper about you in the background. It starts turning into a roar. You're not chasing opportunities anymore, they're chasing you. Whether you're a creator, a business owner, an investor, a leader, or even just someone who shows up with integrity, every interaction, every decision, every piece of value you've ever put into the world has left a trace. That trace turns into a trail. And over time, that trail becomes a track record. And that track record is your reputation. And here's the truth that most people underestimate. Your reputation compounds faster than money ever will. Because when people trust your name, the doors open before you knock. You don't have to prove yourself in every room. You walk in with credibility already on your shoulders. This level hits different because after years of wondering if anyone noticed, they finally do. They notice your consistency, your work ethic, and your resilience. You no longer have to scream to be heard. Your results speak for you. Your past clients speak for you. Your audience speaks for you. And what's even crazier, this kind of credibility can't be bought. It has to be earned. You can't fake it. You can't shortcut it. You have to live it, day in and day out until people know this person delivers. Compounding reputation isn't just about fame or followers, it's about leverage. When people trust you, things happen faster, cheaper, and more efficiently. You don't need to beg for partnerships. People want to collaborate. You don't need to fight for attention. Your content gets shared without you asking. You don't need to run expensive ads. Your name becomes a magnet. That's the kind of equity that can take decades to build, but can create lifelong impact. And the real beauty? It multiplies. Every great interaction you've ever had feeds the next one. Every piece of value you've dropped becomes a seed that grows in someone else's life, and they remember that. And now let's talk risk. When your reputation compounds, you also have more to lose. One mistake, one moment of arrogance, one breach of trust, it can hit harder. That's why, at this level, character matters more than ever. You've got to protect your name like it's your most valuable asset because it is. Money comes and goes. Opportunities rise and fall. But a good name, that can open doors for generations. So if you're here or even starting to feel the momentum of this level, stay grounded, stay consistent, because when your whisper turns into a roar, the world starts listening. And what they hear will be shaped by everything you did when no one was watching. This is the true reward of compounding, becoming the kind of person whose name alone creates opportunity. Level 6. Mastery through time. At level 6, it's not just your money that's growing or your reputation or your income streams, it's your ability. The skills you've been sharpening over the years, day by day, hour by hour, have now evolved into something rare, valuable, and deeply powerful. Mastery. See, most people chase results, but they forget that real long-term power comes from skill. Because when you master something, whether it's investing, writing, coding, selling, leading, negotiating, creating, teaching, designing, you unlock a kind of leverage that can never be taken from you. Skills don't get taxed. They don't disappear in a recession. They don't fade with trends. They compound. And when they do, they create opportunities that money alone never could. And here's what's powerful about this level. You start to realize how far you've come. Tasks that used to take you 10 hours now take 10 minutes. Challenges that used to scare you now feel like warm-ups. Where others feel pressure, you feel flow. That's not just experience, that's accumulated skill weight. You've put in the reps. You've made the mistakes. You've learned the nuance. And now your execution is cleaner, sharper, and more confident, and people feel that. But it goes even further, because once your skills compound, you stop competing on price and start competing on value. You're no longer a commodity. You're not just someone who does X, you're the one. And that puts you in a position where you get to choose the terms. You set your rates. You choose your clients. You dictate your schedule. Skill gives you freedom. Freedom from dependency, freedom from insecurity, and freedom from the fear of starting over. Compounding skill isn't fast, it's frustrating. It feels slow. You question yourself. You compare yourself. You wonder if you're even getting better. But skill building is like weightlifting. You don't see the gains day by day, but 6 months in, people start noticing. A year in, you start noticing. And 5 years in, you become dangerous in the best way possible. Because when you can do what few others can do, the world rewards you in ways money can't measure. The mindset shift you need at level 6 is to stop chasing results and start chasing refinement. Keep learning, keep sharpening, keep obsessing over the craft. Ask yourself, how can I get 1% better today? That's how mastery compounds, not in leaps, but in layers. And when those layers stack, the difference between a good skill and a great one is everything. So if you're someone who's been putting in the hours, studying, practicing, failing, adjusting, know this. It's not wasted. It's not unseen. It's a continuous level of compounding you've been doing. And one day, you're going to look back and realize you don't just have a skill, you are the skill. You've become the asset. And that makes you unstoppable in any economy, any industry, any arena. This is level 6, where quiet practice becomes loud mastery, where your talent meets your discipline, where you stop hoping for success and start executing it like second nature. Stay consistent, stay obsessed, because mastery isn't luck. It's earned through time, patience, and relentless commitment to the craft. Level 7. The power of who you know. This is the level where everything begins to scale beyond what you can do alone. Because no matter how talented, disciplined, or smart you are, there's a ceiling to what one person can achieve by themselves. But when your network starts compounding, that ceiling gets shattered. This is where the people around you become the accelerators of your growth, your opportunities, and your network. Your network becomes your net worth. Not in theory, but in actual, measurable results. You can work 10 times harder, or you can build the right relationships and move 10 times faster. You can grind every day, or you can know someone who opens one door that changes everything. That's not hype, that's leverage. When you consistently add value to others, stay connected, operate with integrity, and genuinely support the right people, something magical happens over time. You stop chasing rooms and the rooms start calling you in. Now, here's where most people mess this up. They think networking is transactional, like it's about collecting business cards, sending cold DMs, or only hitting people up when they need something. That's not how compounding networks work. A compounding network is earned, not collected. It's built by consistently showing up as someone who brings value, not someone who takes it. It's built through years of collaboration, reliability, and authenticity. The people who succeed at this level are the ones who ask, "How can I help you?" Not, "What can I get from you?" What makes this level powerful is that you start to realize just how much who you know shapes where you go. You get introduced to someone you never thought you'd meet. You're offered opportunities you didn't even know existed. You gain access to resources, investments, platforms, partnerships, and wisdom that would have taken you years if you could have done it alone. And the best part? You're now in a position to do the same for others. You start helping people rise with you. You start compounding value within your community. That's when your network goes from just being powerful to becoming purposeful. Relationships are a long game. The person you help today with zero expectation might become the person who funds your business 5 years from now. The friend you supported through tough times might become your business partner, investor, or biggest supporter. That's why you never burn bridges. That's why you treat people with respect no matter their status. Because value in a compounding network often shows up later, but when it does, it can change your entire direction. And let's be real, this level requires a shift in identity. You can't stay in the lone wolf mindset. You can't be the person who hoards knowledge or avoids connection because of fear or ego. You've got to be intentional about who you surround yourself with. You have to invest time in relationships like you would in a business. You have to give without keeping score. So if you're still trying to do it all on your own, pause. Think about the people you're connected to, the people who inspire you, the people you could learn from, help, or collaborate with. Ask yourself, am I watering those relationships the way I should be? Because a network doesn't grow from a one-time interaction. It grows from consistent connections and mutual value over time. And once it compounds, it becomes one of the most powerful assets you'll ever have. Level 8. Beyond you. This level is not about becoming a millionaire, buying your dream house, or getting the applause of strangers on the internet. Level 8 is about something far deeper. This is the level where the compounding no longer just benefits you. It starts to benefit others. Long after you're done, long after you've stepped away, long after the grind is over. This is the level where what you built continues to grow and serve people even when you're not in the room, even when you're not alive. Let's be honest, everyone wants to win. Everyone wants to get rich, retire early, be free. But very few people ask a deeper question. What happens after I win? What do I leave behind? What systems, what principles, what seeds am I planting today that will bear fruit not just for me, but for others, for my children, for my community, for strangers I'll never meet? Because when you hit level 8, the focus shifts from success to significance, from short-term gain to generational impact. This is the level where the wealth you've built turns into structure, where your story becomes a blueprint and the habits, assets, and mindset you developed now serve as a foundation others can build on. Your name starts opening doors for people who share your DNA, your values, or your vision. That business you started outlives you. That content you created continues to teach. That trust you built, it transfers to your kids. That system you set up, It keeps feeding your family. The real reward at this level is not what you own, but what you leave. And here's what's wild. This level of compounding works the fastest when you're not around to see it. You don't always get applause or thanked, but the impact is real. It shows up in the next generation's freedom, in your child not having to start from zero, in someone quoting you years after you're gone, in the ripple effect of a life that mattered. But this level takes sacrifice. It takes vision. It takes doing things today that won't reward you for years. It means creating systems that work without you, teaching what you've learned, documenting what works, putting people in a position to succeed, even if they shine more than you. That's why most people never reach level 8. They're too focused on being the face of the win instead of being the foundation of one. But the ones who do reach this level, they don't just succeed, they create a standard. Also, this level is powerful because it forces you to confront something deep. What kind of ancestor am I becoming? What will my kids say about how I moved? What will the next generation inherit from me, debt and confusion, or wisdom and direction? Because let's face it, some people pass down trauma, bad habits, poverty, and confusion. Others pass down structure, values, wealth, and clarity. One is survival, the other is legacy. So if you're building right now, if you're grinding, learning, saving, investing, creating, know this. Every smart decision you make compounds into something much bigger than money. You are building a story that others will follow, a map they will use when they're lost. You are, right now, laying bricks that someone else will stand on. And whether you ever get to see the full height of that building or not, it will matter, stand, and outlive you. So, how do you climb the levels of compounding? Let's break this down step by step because climbing the levels of compounding is not a mystery, and it's definitely not reserved for the ultra-rich, the ultra-connected, or the ultra-lucky. It's a strategy, and more importantly, it's a lifestyle. But most people stay stuck at level 1 or 2 their whole lives because they don't know how to climb. So let's talk about how you actually move up, from the slow, frustrating beginnings all the way to legacy-level wealth and impact. 1. Start where you are, with what you have. The climb doesn't begin with money. It begins with consistency. Some people delay the journey because they think they need a big income, a business idea, or a perfect plan. That's the trap. What you need is habitual momentum. If all you can invest is $10 a week, do it. If you can only learn for 30 minutes a day, do it. If you're only earning minimum wage, but you save 5% and cut your expenses by $20, do it. Climbing starts with proving to yourself that you're serious, even when the numbers are small. That's level 1 discipline. Every person who's ever built wealth, a brand, a skill, or a legacy, started with what they had, not what they wished for. Your job isn't to be perfect. It's to be consistent. Small money turns into big money. Small ideas turn into major impact, but only when you give them time to compound. 2. Track your progress. Don't guess. You can't climb levels you don't track. You need to see your growth to believe in it. This is where most people fall off. They make progress but don't feel it because they aren't measuring it. Track your investments. Track your savings. Track your skill growth. Track your progress. Not obsessively, but intentionally. Because numbers tell the story your feelings often lie about. Feeling stuck? Look at the data. Is your net worth going up, even slowly? Are your views, subscribers, or customers growing? Are you getting better at your craft? That's momentum. And momentum, over time, explodes, but only if you keep feeding it. Tracking helps you stay motivated during the slow times when most quit. 3. Delay the rewards, double the results. This one's hard. This is the mental game. If you want to climb the levels of compounding, you have to get comfortable with delayed gratification. That means letting your money sit and grow instead of spending it. It means reinvesting your earnings into tools, skills, and platforms instead of flexing on social media. It means saying no to good things now so you can say yes to great things later. Think of it like this. The higher up you want to climb, the more patient you need to be. Every level requires you to resist the urge to cash out early. People who stay stuck are constantly resetting. They build a little, then spend it. Start a project, then quit it. Save a little, then drain it. That's a compounding killer. But when you delay rewards and keep compounding, you hit that point where things take off, and when they do, it's not 2 times better. It's 10 times. That's the power of waiting. The reward multiplies because you waited. 4. Focus on skill before status. One of the biggest reasons people never climb is because they're too focused on looking successful instead of becoming skilled. At every level, your skill is your multiplier. The better you get, the faster you grow. Don't chase followers, chase mastery. Don't worry about being seen, worry about being useful. You climb by getting so good they can't ignore you, and that means practicing when no one's watching, learning when no one's paying, and staying obsessed with your craft, not your ego. Skill compounds the same way money does. If you commit to 1% improvement every day, over time, you become elite. An elite skill gives you options, opportunities, and income that status never will. 5. Build systems, not just goals. You can't climb without structure. A goal is a finish line. A system is a ladder. Most people set goals like, I want to save $10K or I want 100K followers. But they don't build the daily system that gets them there. You climb when your daily habits work in your favor automatically. Automate your savings. Schedule your content. Block time to learn. Set rules for spending. Build a life that nudges you upward even on the days you don't feel like it. Systems protect you from failure. They protect you from motivation slumps. They keep you moving when life gets hard. And that's the point, because if your climb is dependent on willpower alone, you won't make it. Build systems so that success becomes inevitable, not optional. 6. Audit your environment ruthlessly. You cannot climb the levels of compounding in a toxic environment. If you're surrounded by people who don't get it, who mock your ambition, who waste their time, who spend every dollar they earn, you will fall off track. Not because you're weak, but because your environment shapes your behavior more than you realize. Audit who you spend time with, what you consume online, what habits are normalized around you, then upgrade it. Follow people who challenge you, join communities that elevate you. Get around people who are climbing too, because at every new level, you need a new circle, not for clout, but for growth. Your proximity to momentum will determine how far you go. 7. Think decades, not days. Here's the mindset shift that changes everything. Stop thinking in days, weeks, or even years. Start thinking in decades. Wealth doesn't just belong to the fastest hustler, it belongs to the most patient builder. Skill doesn't just belong to the naturally talented, it belongs to the person who practiced for 10 years straight. When you zoom out and commit to the long game, your decisions get smarter. You stop panicking over short-term setbacks. You stop making emotional choices. You start playing like a pro, not a hobbyist. And most importantly, you start compounding at every level. Because the one thing all compounders have in common, they stayed long enough for the snowball to turn into an avalanche. 8. Give more than you take. This one surprises people, but it's the final key to climbing the highest levels. You grow faster when you shift from extraction to contribution. Help others. Share your wins. Teach what you've learned. Connect people. Support those below you and beside you. Why? Because the network, the reputation, and the relationships you build by giving value, they start compounding too. At level 8, it's not about how much you've made. It's about how much you've multiplied. Legacy is built when your wins outlive you, and that only happens when you stop climbing for yourself and start climbing for those who will follow behind you. Serve others now, and they will carry your name into rooms you'll never step in. So now, we've walked through every level, from planting the first seed of effort, to watching your work multiply, to ultimately leaving something behind that grows even when you're gone. And if there's one thing I want you to take away from this, it's that you don't have to be extraordinary to start. You just have to start. You don't need the perfect setup. You don't need to have it all figured out. What you need is consistency, patience, and the courage to not quit when it gets boring. Here's the truth that most people miss. The compounding life is not just about money. It's about growth in every area: your habits, your mindset, your health, your skills, your relationships, and your impact. The math is simple, but the mindset is what breaks people. Because the first part of compounding always feels thankless. You're doing the work, but the results are so small you start to wonder, is this even worth it? But the second you ask that question, that's when you're closest to the breakthrough. The pain is loud at the beginning, but the reward, it comes quietly and then all at once. And look, I know this is not some overnight hack. Most people spend their lives starting over again and again because they never gave the right thing enough time. Don't be like most people. Be the person who sees past today. Be the person who stays planted when everyone else is jumping ship. Be the one who keeps building when it's hard, when it's slow, when it's silent, because that's how you win. You are one disciplined year away from changing your entire trajectory. One shift in mindset away from separating yourself from everyone you grew up around. One decision away from climbing to a level that most people will never touch, not because they couldn't, but because they stopped. The levels of compounding don't reward the smartest. They reward the most committed. That means this is a game anyone can win if you're willing to stay in it long enough. So wherever you are right now, whether you're still stuck in level 1 or you're climbing toward legacy, know this: your work is not in vain. Your consistency is not a waste. Your small decisions matter. The numbers might be quiet now, but one day they will scream. The roots are forming. The foundation is set, and if you stay focused, if you stay consistent, if you trust the process, compounding will take care of the rest. This journey is yours. These levels are real. And the life on the other side of compound growth, it's more powerful, peaceful, and freeing than anything quick success could ever offer. So don't just start, commit, stay locked in. And when it gets hard, come back to this message. Come back to this truth. You are building something exponential. Let's talk about one of the most powerful forces in the world: compounding. Whether you've heard the phrase compound interest is the eighth wonder of the world or not, this concept is more than just numbers on a page. It's the secret weapon that can change your financial life. But here's the kicker: compounding isn't just about money sitting in a savings account. There are actually 4 types of compounding, and each of them can take you closer to financial freedom if you know how to harness their power. By the end of this, you'll not only understand these types of compounding, but also know how to apply them in your own life to start building wealth today. Ready? Let's dive in. First up is the most obvious and well-known form of compounding: financial compounding. This is where your money starts working harder than you do. Here's how it works. When you invest your money, the returns you earn, whether through interest, dividends, or capital gains, are reinvested. This means you're earning returns on both your original investment and the returns you've already accumulated. Think about this. A small amount of money invested consistently over time can grow into an enormous sum. For example, if you invest $500 a month at a 10% annual return in 30 years, you'd have over $1.1 million. But here's the wild part: only $180,000 of that is the money you put in. The rest, more than $900,000, is the result of compounding. Why does this happen? Because time and consistency are your best friends when it comes to financial compounding. The longer you stay invested and the more disciplined you are about reinvesting your gains, the greater your snowball of wealth becomes. This is why starting early matters. Even small amounts can grow into life-changing sums if you give them enough time. But financial compounding isn't just about stocks or mutual funds. It works in other areas too. Think about dividend-paying stocks, where your earnings are reinvested to buy more shares, or real estate investments, where rental income is reinvested into more properties. The key is to find investments that allow you to reinvest your returns consistently. The second type of compounding isn't about money at all. It's about something even more valuable: your knowledge. Knowledge compounding works like this. The more you learn, the better you get at understanding and applying that knowledge. And over time, the effects multiply. Let me break it down. When you start learning a new skill, say coding, investing, or public speaking, you're not just adding one skill to your toolbox. You're creating connections between what you already know and what you're learning. These connections make it easier and faster to learn the next thing and the thing after that. For example, think about someone who learns basic investing. At first, they might only understand the concept of buying low and selling high. But as they dive deeper, they'll learn about asset allocation, risk management, and tax efficiency. Each new piece of knowledge builds on the last, making them a more effective investor. Over time, their decisions become sharper, and their results improve exponentially. Knowledge compounding also works because it's transferable. The skills you gain in one area often apply to others. For instance, learning discipline through fitness can help you stick to a financial plan, or mastering communication skills can make you a better negotiator, which can lead to higher pay or better deals. The takeaway: invest in your education. Read books, take courses, surround yourself with mentors. Every bit of knowledge you gain has the potential to multiply your future opportunities and outcomes. And just like financial compounding, the earlier you start, the bigger the impact. The third type of compounding is relationship compounding, and this one's often overlooked. The idea here is simple. The connections you build today can open doors tomorrow. But the magic happens when those relationships grow and multiply over time. Think about this. Every strong relationship you form, whether personal or professional, is like planting a seed. With care and effort, that seed can grow into a tree. And as you nurture more relationships, you end up with an entire forest. Here's the kicker. A forest doesn't just provide shade for you. It creates opportunities, collaborations, and support systems that benefit everyone involved. For example, let's say you're an entrepreneur. Your initial relationships might help you find your first clients. Over time, as you deliver value, those clients recommend you to others and your network expands. Eventually, opportunities come to you without you even asking, because you've built a reputation and a network that compound over time. But this isn't just about business. Relationship compounding works in your personal life too. Strong relationships with friends and family provide emotional support, perspective, and even financial advice when you need it most. These connections grow stronger with time, creating a foundation for a richer, more fulfilling life. So how do you make relationship compounding work for you? Focus on giving more than you take. Be genuinely interested in others, provide value, and stay consistent. Over time, the goodwill you build will come back to you many times over, often in ways you can't predict. Finally, let's talk about habit compounding. This is the idea that small, consistent actions lead to massive results over time. It's like stacking bricks. One brick might not look like much, but if you keep stacking every day, you'll eventually build a wall, or even a castle. Habits are powerful because they automate your progress. Once something becomes a habit, you no longer have to think about it. It just happens. And over time, the results compound. For example, saving $10 a day might not feel significant at first. But over a year, that's $3,650. Over a decade, with interest, it could be tens of thousands. The same applies to health. A 20-minute workout 3 times a week might not transform your body overnight, but over months and years, it can lead to significant improvements in your strength, endurance, and overall health. Or consider learning. Reading just 10 pages a day adds up to 3,650 pages a year, the equivalent of 10 to 15 books. The key to habit compounding is consistency. It's not about making giant leaps. It's about taking small, steady steps in the right direction. The best part: as you build positive habits, the effort required decreases while the rewards increase. That's habit compounding at its finest. So, as you can see, compounding isn't just a financial concept. It's a universal principle that applies to money, knowledge, relationships, and habits. When you start leveraging all 4 types of compounding, you're not just building wealth, you're creating a life of exponential growth and opportunity. The reality, compounding takes time. It's not about quick wins or overnight success. It's about patience, discipline, and a commitment to the long game. It's about starting as early as today. As the earlier you start and the more consistent you are, the greater the rewards. So what can you do today to start harnessing the power of compounding? Maybe it's opening that investment account, signing up for a course, reaching out to someone you admire, or committing to a small daily habit. Whatever it is, take that first step. Because every step you take today compounds into something greater tomorrow. And remember, the magic of compounding doesn't just happen. You have to make it happen. So, what are you waiting for? Start compounding your way to a richer, fuller life today. If you've ever wondered how the wealthy manage to stay rich and even grow their wealth over time, you're in the right place. We're going to explore 7 of the best compounding assets that the wealthy use to preserve their wealth, as preserving wealth is a fundamental concern for the wealthy. Compounding assets refer to investments that generate returns, which are then reinvested to generate further returns, thus compounding over time. These compounding assets are tried and proven wealth preservers that have stood the test of time. So, let's jump right in. 1. Dividend-paying whole life insurance. When we talk about wealth preservation, dividend-paying whole life insurance often flies under the radar, but it's a hidden gem in the world of financial growth and protection, especially for the wealthy. Unlike term life insurance, which only provides coverage for a specific period, whole life insurance offers coverage for your entire life. But what sets it apart is the cash value component. The cash value grows on a tax-deferred basis, allowing policyholders to accumulate wealth within the policy while enjoying the benefits of life insurance protection. As you pay your premiums, a portion goes into a cash value account that grows over time, thanks to compounding interest. This cash value can be accessed through policy loans or withdrawals, providing liquidity when you need it. Additionally, some whole life insurance policies pay dividends that compound over time, which policyholders can choose to receive as cash, used to purchase additional coverage, or reinvest to enhance the policy's growth potential, further enhancing the policy's value. Moreover, the death benefit of whole life insurance policies is typically income tax-free, providing a tax-efficient means of transferring wealth to beneficiaries. For the wealthy, who often have complex financial needs and estate planning considerations, they leverage dividend-paying whole life insurance as a cornerstone of their estate planning strategy, ensuring financial security for their loved ones while preserving liquidity and tax advantages. 2. Gold. Gold has stood the test of time as a store of value, And it's no surprise that the wealthy have long favored it as a wealth preservation asset and its compounding prices and worth over the years. In times of economic uncertainty or market volatility, gold tends to shine. Its scarcity, durability, and intrinsic or inherent value make it a reliable hedge against inflation and currency devaluation, and most importantly, a wealth preservation. Unlike paper currency, which can be printed at will by governments, gold cannot be replicated, meaning its price tends to rise during periods of market volatility, inflationary pressures, and geopolitical instability, providing investors with a safe haven for preserving purchasing power, thereby ensuring that it retains its value over the long term. So, wealthy individuals often allocate a portion of their investment portfolios to physical gold or gold-backed exchange-traded funds, ETFs, to hedge against systemic risks and currency devaluation, as gold serves as a safe haven asset, providing peace of mind and stability in turbulent times. 3. Real estate, the most known and celebrated asset of many wealthy individuals' investment portfolios. Real estate has long been synonymous with wealth, and for good reason. It is a tangible asset class that offers multiple avenues for wealth preservation and growth like residential properties and commercial properties, making it a favorite among the wealthy. First and foremost, rental properties generate passive income in the form of rental payments, providing a steady cash flow stream regardless of market conditions, which can be reinvested to acquire additional properties or diversify investment portfolios. Additionally, real estate values tend to appreciate over time, offering capital appreciation potential. Also, as rich, wealthy people love debt so much, most tend to leverage mortgages to finance most of their real estate acquisitions, which amplifies their returns, as investors' equity increases with property appreciation and mortgage paydown. Moreover, real estate provides diversification benefits, as it often moves independently of the stock market. For the wealthy, real estate isn't just about owning property. It's about owning assets that provide steady income streams and long-term appreciation, all while hedging against inflation and market volatility. 4. Investments. When it comes to preserving wealth, the wealthy understand the power of investment vehicles. Stocks, index funds, bonds, and fixed income securities form the backbone of many rich and wealthy affluent individuals' portfolios, as they not only compound over time, they also preserve their wealth. These assets offer a blend of stability, growth potential, and income generation that is essential for long-term wealth preservation. The wealthy carefully select a mix of investments tailored to their financial goals, risk tolerance, and time horizon. Whether it's investing in stocks for steady dividends, index funds for broad market exposure, or bonds for fixed income, they strategically diversify their investments to weather market volatility and economic fluctuations. That's why you will always hear that a wealthy individual has shares of stocks of their own company, and even for other companies, not only for capital appreciation and dividend income, but also for preserving their wealth. Index funds provide diversified exposure to broad market indices, allowing investors to capture the overall performance of the stock market with low fees and minimal effort. And if you find rich and wealthy people with index funds, then they are just adding a little side piece to preserve their wealth. As for government bonds, municipal bonds, corporate bonds, and treasury securities provide various risk-return profiles and cash preservation to suit their preferences. Diversifying investment portfolios across stocks, index funds, bonds, and fixed income securities helps mitigate risks associated with individual asset classes and enhances long-term returns through compounding. 5. Private business. One of the most powerful ways the wealthy preserve and grow their wealth is by starting and investing in their own private business. Owning a business not only provides a source of income but also allows for significant wealth accumulation through business growth and expansion. The wealthy often take an active role in managing their businesses or investing in promising startups through venture capital firms. By leveraging their expertise and networks, they can identify lucrative opportunities and generate substantial returns over the long term. They understand the value of entrepreneurship and invest in businesses across a variety of industries, from technology and healthcare to manufacturing and retail. Additionally, owning a private business offers tax advantages and asset protection benefits, further enhancing wealth preservation strategies. For the wealthy, owning a private business isn't just about making money. It's about creating value, leaving a legacy, and securing financial freedom for themselves and future generations. If maybe they don't have their own company, and this is a big if, as most wealthy people are obsessed with having something they can call their own or is in their name, they may also decide to invest in private equity or a hedge fund. Private equity and hedge funds are the playgrounds of the wealthy, offering exclusive opportunities for wealth preservation and growth. Private equity investments involve acquiring equity stakes in other private companies, often with the goal of restructuring and selling them for a profit. Hedge funds, on the other hand, employ a variety of sophisticated strategies to generate returns while managing risk. From long or short equity to macroeconomic bets and arbitrage, hedge funds offer access to exclusive investment opportunities not available to the average investor. The wealthy allocate a portion of their portfolio to these alternative assets to diversify risk and maximize returns. While private equity and hedge funds can be complex and risky, they also offer the potential for outsized returns, making them attractive options for preserving and growing wealth over the long term. By building and acquiring successful businesses, they create streams of passive income and long-term wealth that can withstand economic downturns and market volatility. As we move on to the remaining wealth-preserving compounding asset, kindly like the video if you find it informative and constructive so far. Also, do leave a comment below on your view of this video and any other compounding assets that are great for preserving wealth. Let's continue. 6. Land. Just like real estate, land is another compounding asset favored by the wealthy. It is a timeless asset favored by the wealthy for its stability and long-term appreciation potential. Whether it's agricultural land, development land, or commercial real estate, owning land offers numerous benefits for wealth preservation and growth. Land is a finite resource, and as populations grow and urbanization continues, its value tends to increase over time, making it a solid long-term investment. The wealthy understand the value of land as a tangible asset that can withstand economic fluctuations and provide a hedge against inflation. Additionally, land can generate income through farming, leasing, or development, further enhancing its appeal as a compounding asset. For the wealthy, owning land isn't just about property rights. It's about securing a valuable asset that can be passed down through generations. By strategically acquiring and managing land holdings, the wealthy can diversify their portfolios, hedge against inflation, and preserve wealth for the future. 7. Collectibles and tangible assets. Beyond financial instruments, the wealthy also diversify their portfolios with tangible assets and collectibles. From rare artwork and vintage wine to classic cars and luxury watches, collectibles offer a unique opportunity for wealth preservation and appreciation. The wealthy see value beyond monetary returns in these assets as they are obsessed with these items and appreciate the history, craftsmanship, and cultural significance of collectibles. These assets often hold intrinsic value and have demonstrated resilience during economic downturns. Moreover, they provide diversification outside traditional financial markets and offer potential tax advantages, such as favorable capital gains treatment for certain collectibles. The wealthy carefully curate their collections, focusing on assets with proven track records of appreciation and demand, as these artworks, vintage wines, classic cars, and watches are sought year after year, and at the same time, their prices rise year after year. Additionally, investing in tangible assets can provide personal enjoyment and fulfillment, further enhancing their value beyond financial returns. While collectibles and tangible assets may require specialized knowledge and expertise to evaluate, they can serve as valuable components of a diversified investment portfolio. So if you have a luxury watch with you now, hold on to it, as you may not know its value in the next 5 to 10 years. Every one of us is looking for the simplest yet effective way to start investing and become rich in the shortest time possible. In this video, I will be introducing to you the 8-4-3 rule of compounding that I have been using to multiply my money in just 4 years. You've probably heard about compounding before, especially if you aren't new to the channel, as I have several videos on this topic. But if you are new to the channel, let's start by breaking it down in simple terms before discussing the rule. Compounding is essentially when you invest some money, and over time, you earn a return on that investment, and instead of withdrawing those earnings, you reinvest them. Over time, your initial investment grows, and so do your earnings. This cycle repeats, and before you know it, your money starts growing exponentially over time. That's the power of compounding in a nutshell, and it's incredibly powerful. So, what is the 8-4-3 rule, and how does it fit into all of this? Let's break it down step by step. The 8-4-3 rule of compounding offers a simple yet powerful framework for wealth building. It involves 3 key elements: return on investment, ROI, investing duration, and the number of assets to invest in. Let me explain each number on the rule for easier understanding. The 8 represents an 8% return on investment, which is a realistic and achievable target for many investors. This percentage accounts for both capital appreciation and dividends, providing a steady stream of income while also allowing your investment to grow over time. The 4 signifies a 4-year duration, emphasizing the importance of long-term thinking in the world of investing. By staying committed to your investments for at least 4 years, you give them the time they need to weather short-term fluctuations and realize their full potential. Finally, the 3 highlights the significance of diversification across 3 different assets. Now, you might be thinking, why invest in 3 assets? Well, to diversify your investments by spreading them across different assets to reduce your risk and increase your chances of long-term success. Let's say you put all your money into one asset like the stock market and it doesn't perform as expected. You could end up losing a significant portion of your investment. But by diversifying, you're not putting all your money in one investment. So, even if one asset underperforms, the others can help offset the losses, keeping your overall portfolio more stable. So, whether you're a seasoned investor or just starting out, the 8-4-3 rule provides a clear roadmap for achieving financial success in a short period of time. To understand how this works, let's look at an example. Let's say Alex has $15,000 now lying in his bank account. Alex knows banks don't really offer the best returns, so he decides to divide the money equally and invest it in 3 assets. These are stocks, index funds, and real estate investment trusts. Index funds representing the broader market, stocks from consumer stable or tech companies, and real estate investment trusts for exposure to real estate. Over the course of 4 years, assuming an average annual return of 8% for each asset, Alex's initial $5,000 investment in each asset will grow to approximately $6,800 on each investment, adding up his total final investment after 4 years to approximately $21,000 from $15,000. In another scenario, let's say Alex commits to a disciplined monthly contribution of $500 to each asset. After 4 years, each of his assets will have grown by 8%, resulting in each of his investments being valued approximately at $34,000, adding up the total value of the 3 investments to over $102,000, showcasing the remarkable potential of the 843 rule when applied to a diversified investment strategy. Okay, so now that we understand the 843 rule and the power of compounding, how do we put it into action? Well, by using the following simple principles of smart investing. 1. Start early and stay consistent. Starting early is crucial in the world of investing because of the power of compounding, as time is one of the most critical aspects of any investment strategy. Even small amounts invested consistently over time can grow into significant sums due to the compounding effect. By starting early, you give your investments more time to grow, which can ultimately lead to greater wealth accumulation in the long run. Plus, starting early allows you to weather market fluctuations and take advantage of the natural ups and downs of the market without panicking. Set a budget, stick to it, and make investing a priority, just like you would with any other financial commitment. 2. Automate your investments. Life can get busy, and it's easy to forget to invest regularly. That's where automation comes in handy. Set up automatic contributions to your investment accounts, whether it's through your employer's retirement plan, a brokerage account, or a robo-advisor platform. By automating your investments, you remove the temptation to spend that money elsewhere and ensure that you're consistently adding to your portfolio over time. 3. Reinvest your earnings. Reinvesting your returns is a powerful way to accelerate the growth of your investment portfolio. Instead of cashing out or pocketing your gains, reinvest them back into your portfolio to take advantage of the compounding effect. Reinvesting dividends, interest, and capital gains allows your money to continue working for you, compounding over time and generating even greater returns. This simple yet effective strategy can significantly boost the long-term growth of your portfolio, helping you achieve your financial objectives sooner. 4. Diversify your portfolio. Diversification is often referred to as the only free lunch in investing. By spreading your investments across different asset classes, industries, and geographical regions, you can reduce the overall risk in your portfolio. If one asset performs poorly, others may perform well, helping to offset losses and stabilize your overall returns. Diversification can help you achieve a more consistent and smoother investment journey, protecting your wealth over the long term. 5. Focus on quality investment. Quality over quantity is a mantra that holds true in investing. Instead of chasing high-risk, high-reward opportunities, focus on quality investments with strong fundamentals and a track record of steady growth. Look for companies with solid financials, reliable cash flows, and sustainable competitive advantages. Similarly, when investing in other asset classes like real estate or bonds, prioritize assets with proven stability and income-generating potential. By focusing on quality investments, you can reduce the risk of permanent capital loss and increase the likelihood of achieving your financial goals. 6. Stay disciplined and patient. Investing can be a roller coaster ride with ups and downs along the way. During periods of market volatility or economic uncertainty, it's essential to stay disciplined and avoid making impulsive decisions based on fear or greed. Stick to your investment plan. Focus on the long-term horizon and resist the temptation to time the market or chase short-term gains. Remember that successful investing is about time in the market, not timing the market. By staying patient and letting the power of compounding work its magic, you'll be well positioned to achieve your financial goals over the long haul. 7. Stay informed. Stay educated about the market and economic trends that can impact your investments. Keep yourself updated on the performance of your investments and be prepared to adjust your strategy as needed. This doesn't mean trying to time the market or chasing hot investment trends, but rather staying disciplined and sticking to your long-term investment plan. Consider consulting with a financial advisor to help guide your investment decisions and ensure your portfolio remains aligned with your goals. The beauty of this rule lies in its simplicity and effectiveness. It's not about getting rich quick, but rather about steadily building wealth over time through the power of compounding. So, whether you're just starting your investing journey or looking to level up your strategy, remember the 8-4-3 rule as your blueprint for long-term success. Most people go into investing blind. They hear things like start early, let your money compound, or just invest and hold, but they have no real sense of how much they need to invest to hit their targets. Majority of us don't realize that there's an actual rule, a simple ratio, that helps you figure out how much you need to invest to hit your financial goals. This rule is called the 7-3-2 rule of compounding, and trust me, once you get this, your entire approach to investing your money is going to change. This rule helps you estimate how much of your future wealth will come from your own investments versus the returns on those investments. It also helps you figure out how much you should be investing today if you want to hit a specific investment goal. Once you understand this, you'll never look at investing the same way again. At its core, the 7-3-2 rule is a simple way to estimate how much of your investment growth will come from your own contributions versus your returns, and how much money you actually need to invest to reach your goal. It's not exactly the same as the 8-4-3 rule of compound or the rule of 72 that I have talked about in this channel, as these two rules don't tell you the amount you need to invest to reach your investment goals. Rather, they only show you how long your investments will grow. The 7-3-2 rule gives you a strategy to know the amount needed to reach a particular investment goal. Here's how it works. 7 represents the portion of your final target amount that will come from your initial investment. In other words, 70% of your future wealth will come from you. 3 is the portion that will come from the growth and returns over time with compounding. That's 30% of the compounded return from the total investments amount. 2 represents the ratio of your investment to the total amount you need, investment plus returns, in a single year. That is to say, if you want to achieve your financial goal in 1 year, your investment should be at least half, 50% of the target amount you're aiming for. And so, what does this actually mean in real numbers? Let's break it down further so it really clicks. Let's say your goal is to build a $100,000 investment portfolio over time. How much of that money needs to come from you, and how much can come from returns? Using the 7-3-2 rule, 70%, which is $70,000, needs to come from your direct investments, that is from your own pocket, and 30%, which is $30,000, will come from returns of your investment compounding. But if you were trying to build this portfolio in 1 year, then the ratio tells you that you would need to invest at least half of the total, $50,000, up front and let compounding do its work. But of course, most people aren't investing for just 1 year. They're investing for years or decades. And that's where the rule gets even more powerful. What's really crazy is that if you let your investments compound over 10, 20, or 30 years, this ratio actually flips. The longer you stay invested, the more compounding works in your favor. Instead of 70% of your money coming from your own contributions, eventually 70% or more could come from your returns alone. That's why people who start investing early don't need to invest as much later on. Their money is already working for them. Using the same example as earlier of $100,000 targeted investment, let's say you invest $10,000 today without additional investment and let it grow for 20 years at an average return of 8% per year. After 20 years, your investment will have grown to more than $46,000, and after 30 years, it will have grown to over $100,000. The wild part, only $10,000 of that is money you actually put in, and the remaining $90,000 came from compounding. If you see 20 or 30 years as a long time and opt for 10 years, then you will take the approach of additional contribution. Let's say you invest $5,000 today with an additional investment of $500 every month and let it grow for 10 years at an average return of 8% per year. After 10 years, your investment will have grown to over $100,000. And if you decide to stop contributing and let the money compound for the next 5 years, then your $100,000 will grow to over $145,000. Only $60,000 of that is money you actually put in, and the remaining $35,000 came from compounding for the first 10 years with contribution, and over $45,000 of the remaining 5 years without contribution. That's the shift that happens when you stay invested long enough. Instead of you working for your money starts working for you. Most people don't realize this, but investing isn't just about putting money in and hoping for the best. If you actually want to hit your financial goals, you need a strategy, and the 732 rule gives you that strategy. It helps you answer key questions like, how much do I actually need to invest? How much will my returns contribute to my total wealth? How long will it take me to reach my goal? And most importantly, it helps you stay on track. All right, so now that you get the concept, how do you actually apply it? Here's a simple step-by-step approach. Step 1. Set your target investment. Decide how much money you want to accumulate in the future. Do you want $100,000, $1 million, or more? Let's say your goal is to have $500,000 for retirement. Step 2. Use the 732 rule to break it down. Use the rule to figure out how much of your goal needs to come from your own investments versus the returns you expect to get from the investment. 70%, or $350,000, will need to come from your own investments. 30%, or $150,000, will come from your returns over time. Keep in mind that this will depend on how long you intend to invest. If you are investing longer, then there is a high chance you will invest 30% of your money, and the remaining 70% will come from returns through compounding. Step 3. Plan your investments. Speaking of long-term investing, if you're looking to reach this goal over, say, 25 years, the 732 rule tells you that you don't need to come up with $350,000 overnight. Instead, you can break it into consistent contributions over time. For instance, if you invest $500 per month at a 10% return, you'd hit this goal in around 25 years, and if you invest $1,000 per month, you'd get there in 18 years. The key is to start as early as possible and be consistent, and compounding works in your favor. Most people completely misunderstand how compounding works, and they end up making one of these 3 mistakes. 1. Waiting too long to start investing. This is the biggest mistake of all. People think, I'll start investing when I make more money. But the longer you wait, the less time you give compounding to work. If you start investing in your 20s, you can invest less money and still retire rich. If you wait until your 40s or 50s, you'll have to invest way more to catch up. 2. Not investing enough. A lot of people think they can just throw in $50 here and there and expect to become wealthy. It doesn't work that way. The 732 rule tells you exactly how much of your future wealth needs to come from your own contributions. If you're not putting in enough, you won't hit your target, no matter how great your returns are. 3. Pulling money out too early. Compounding only works if you stay invested long enough. But a lot of people panic when the market dips and pull their money out. That's like planting a tree and then ripping it out of the ground before it can grow. If you want big results, you have to let your money sit and compound. At the end of the day, increasing your investment isn't about luck. It's about having a simple and manageable strategy. Whether it's the rule of 72, the 843 rule, or the 732 rule, all these rules are simple and powerful ways to understand how wealth is built over time through investing. The bottom line: compounding is the secret to wealth, but only if you give it time. So now that you know the rule, what are you going to do about it? Every one of us is looking for the simplest yet effective way to start our savings journey and be able to multiply it in the shortest time possible. In this video, I will be introducing to you the 553 rule of compounding that I started using last year and still using it up until now to multiply and double my savings in just 5 years. If you aren't new to the channel, I recently revealed the 843 rule of compounding that I was using to multiply my investments in the shortest time period of 4 years. But if you are new to the channel, I would highly recommend that you watch the video, and maybe it'll help. Before discussing more on the 553 rule of compounding, let's first know what compounding your savings means. Compounding in savings is essentially when you save some money and start earning interest on the initial amount deposited plus on the interest that accumulates over time. This cycle repeats itself, and before you know it, your savings grow and double over time. That's the power of compounding when applied to your savings in a nutshell, and as we all know, it's incredibly powerful. So, how does the 553 rule fit into all of this? Let's break it down. The 553 rule of compounding is a powerful concept that involves 3 key elements: annual percentage yield, APY, duration, and the number of savings accounts. It offers a simple yet powerful framework for building your savings faster and in the shortest time possible. Let's break it down. The first 5 represents a 5% annual percentage yield, APY, which is a realistic and achievable target interest rate offered by various savings institutions on their high-yield savings accounts. This is significantly higher than the rates provided by traditional savings accounts, allowing your money to grow more rapidly. The second 5 represents a 5-year duration your savings need to allow it to grow and multiply. This time frame is essential to harness the full power of compounding, allowing your interest to earn interest, thereby accelerating growth. And lastly, the 3 represents the number of separate high-yield savings accounts you will need to have to maximize and fasten your savings goals. Now, I know what you might be thinking. Why save in 3 accounts and not 1? Well, opening 3 separate high-yield savings accounts may sound unusual for some, but this diversification strategy spreads out your risk and maximizes your growth potential. Think of it as planting 3 different trees in your garden. Each tree might grow at a slightly different rate and face different conditions, but collectively they provide a lush, thriving garden. The same applies to your savings. Spreading them across 3 accounts helps mitigate risks and enhances overall growth, as each account has its high and low times, but still continues to grow regardless. You might be wondering why we are focusing on high-yield savings accounts. Well, traditional savings accounts usually offer measly interest rates that barely keep up with inflation. High-yield savings accounts, on the other hand, offer significantly higher interest rates, often around 5% or more. This higher rate means your money grows faster, giving you a much better return on your savings. Apart from that, they are low risk and liquid, unlike investments in the stock market or other volatile assets, and typically offer easy access to your savings when you urgently need it. While it's best to let your savings sit and grow, knowing you can access your funds if necessary provides peace of mind. So, who is this rule for? Well, the 5-5-3 rule is designed for those seeking a reliable, highly effective saving strategy to not only enable them to start saving, but to also enhance and multiply their savings, especially low-income earners. This rule harnesses the magic of compounding interest in your savings accounts over your preferred time frame. To understand how this works, let's look at 3 examples, all with an initial deposit of $1,000 for each account, with 3 different scenarios of additional saving contributions and 1 without additional saving contributions. Each scenario will help illustrate how different contributions affect your savings growth over 5 years. Something to note is that I used the NerdWallet savings calculator to calculate the scenarios we are going to discuss, as it's free to use. You can also use another free calculator from Greater Nevada High Yield Account Calculator to calculate. The final results of the 2 calculators slightly differ, so kindly choose the one that you are comfortable with. Let's start with the simplest scenario, an initial deposit of $1,000 in each of the 3 high-yield savings accounts, and no additional contributions beyond that. In this case, you're only relying on the power of compounding interest to grow your initial savings. Over the next 5 years, your savings will grow, but by the end of the 5 years, each account will have grown from $1,000 to approximately $1,276.28, and all the 3 accounts' total amount will be $3,828.84. In the second scenario, let's assume you start with an initial contribution of $1,000 in each of the 3 high-yield savings accounts, and then add an additional $1,000 to each account at the end or start of every year. This means that your savings account is compounding yearly. At the end of 5 years, each account will have had its initial deposit and annual contributions compounded at 5% interest, and your savings account will increase to approximately $6,801.91. So, for 3 accounts, the total amount will be $20,405.73. In the third scenario, you start with $1,000 in each account and contribute an additional $200 each month. The interest rate is still 5%, but now compounding occurs monthly. Each month, you deposit $200 into each account. The interest compounds monthly, and by the end of the 5 years, the future value of one account will be approximately $14,884.58. Across all 3 accounts, the total value would be around $44,653.74. These 3 scenarios illustrate how different contribution strategies and interest compounding can significantly impact your savings over time, meaning the more you contribute and the more frequently you let your money compound, the greater your financial growth will be. So, whether you're just starting or looking to ramp up your savings strategy, understanding how these contributions work can help you make more informed financial decisions and get closer to your savings goals. Now that you understand the 5-5-3 rule of compounding your savings, let's talk about how to implement it. Here's a step-by-step guide. First, research high-yield savings accounts. Look for accounts that offer competitive interest rates of around 5% or higher. Don't rush. Take your time to compare the rates and terms and use online comparison tools and financial reviews to find the best options. Next, open 3 separate high-yield savings accounts. Once you've found the right accounts, go ahead and open 3 of them. Make sure each account is with a different bank or financial institution to diversify your risk and ensure you benefit from compounding in each one. After setting up the accounts, deposit your initial savings. This could be an equal amount in each account or adjusted based on your goals. Then, establish a regular contribution plan if possible. Whether you choose to contribute monthly, quarterly, or annually, consistent contributions will further enhance your compound interest growth. Finally, monitor your accounts periodically to ensure they continue to offer competitive rates and adjust your strategy if needed. Finding the right high-yield savings accounts is crucial for optimizing your returns. Start by comparing interest rates offered by different banks and financial institutions. Look for accounts with high rates and favorable terms. Additionally, consider fees and minimum balance requirements. Some accounts may have high fees or require a minimum deposit that could impact your overall returns. Check the compounding frequency. Accounts that compound interest more frequently, for example, monthly, will yield higher returns. Read customer reviews to gauge the reliability and customer service of the banks you're considering. Finally, ensure that the accounts are FDIC insured to protect your deposits up to the insured limit. Some of the best high-yield saving accounts in the United States include Brio Direct High Yield Savings Account, Ivy Bank High Yield Savings Account, Laurel Road High Yield Savings, UFB Secure Savings, Lending Club High Yield Savings, Basque Interest Savings Account, Newtek Bank Personal High Yield Savings, just to name a few. By carefully selecting accounts that meet these criteria, you can maximize the benefits of the 5-5-3 rule and watch your savings grow more effectively. So, why go through all this effort? Well, the 5-5-3 rule of compounding offers several significant benefits for growing your savings. 1. Maximized returns. By targeting high-yield savings accounts with around 5% interest, you significantly increase the returns on your savings and maximize the power of compound interest compared to traditional savings accounts. This higher rate of return accelerates the growth of your money, allowing it to earn interest on both the principal and the accumulated interest, significantly increasing your returns over time. 2. Promotes disciplined saving. The rule encourages regular deposits and a structured approach to savings, fostering good financial habits. Whether you're contributing annually or monthly, sticking to a plan helps build a steady accumulation of wealth. 3. Diversification. Opening 3 separate accounts spreads your risk across different accounts. This diversification helps protect your savings from potential issues with any single bank and ensures that you are not overly reliant on one financial entity for your returns. 4. Simplifies financial management. The rule's clear structure is 3 accounts that grow for 5 years and a focus on high-yield saving accounts, making it easier to follow and track your progress. 5. Low effort, high impact. Once set up, the 5-5-3 rule requires minimal ongoing effort. After making your initial deposits and setting up contributions, you can let your money grow with little intervention. This ease of maintenance makes it an attractive strategy for busy individuals looking to maximize their savings without constant monitoring. This saving strategy is about steadily building your savings account over time through the power of compounding. So, whether you're just starting your savings journey or looking to level up your saving strategy, remember the 5-5-3 rule as your blueprint for long-term saving success challenge. When it comes to the world of investing, the power of compounding is king. I recently revealed how I have been able to multiply my investments in the shortest time possible of 4 years using the 8-4-3 rule of compounding, and you love this rule of compounding. Reading through your comments, I come across someone's comment on another rule of compounding that they are applying for their child so that when the child gets older, they get to become a millionaire. So, in this video, I'm going to discuss another great rule of compounding with a longer investing duration of 20 years. This is the 722 rule of compounding. But before I get to expand on this rule, if you had some inquiries on the previous video of the 843 rule of compounding, then stick around for I will be giving my take on it. Let's begin. If you've watched my previous video on the 843 rule of compounding, then you know the basics of what each number of the rule signifies. The same goes with today's discussion on this rule that I'm discussing today, the 722 rule of compounding. If you are new, let's break down each number of the rule. So, what exactly is the 722 rule of compounding? Well, it's another simplified approach to multiply your investment where 7 represents a 7% return on investment, ROI, which is a realistic and achievable target for many investors and investment vehicles as it accounts for both capital appreciation and dividends. The 20 represents a 20-year investment duration, emphasizing the importance of long-term thinking in the world of investing, as staying committed to your investments for 20 years, you give them the time they need to weather short-term fluctuations and realize their full potential long time. And finally, the 2 highlights the significance of diversifying across 2 different assets of your choice, as spreading your investments across multiple asset classes enables you to mitigate risk and increase your chances to successfully grow wealth long term. As we said in the previous video, don't put all your money into one asset, as you will be at risk of losing a significant portion of your investment in case the asset doesn't perform well. But by diversifying, even if one asset underperforms, the other can help offset the losses, keeping your overall portfolio more stable. Something really amazing about this rule is that it can be used for both adults like you and me, and also for children to build wealth long-term for 20 years. Starting with the adults, let's look at an example of 2 adults. One is 25 years old and the other is 35 years old. Let's say both of them have $10,000 that they divide equally and invest in 2 assets. These are tech stocks that represent the potential for exponential growth in the continuously evolving tech industry, and index funds that represent broader markets from different companies and industries. Over 20 years, assuming an average annual return of 7% for each asset, both individuals, the 25-year-old and the 35-year-old initial $5,000 investment in each asset, will grow to approximately $19,348 on each of their investment, adding up their total final investment after 20 years to approximately $38,696 from $10,000. Comparing the 2 scenarios, we see that both individuals end up with the same total value of investments after 20 years. However, the advantage of starting at 25 years old lies in the opportunity for longer compounding. While both individuals achieve the same final result, the 25-year-old benefits from an additional 10 years of compounding. This extra time allows their investments to grow and compound more effectively, resulting in potentially greater wealth accumulation over the long term. Let's revise the scenario with additional monthly contributions from both the 25-year-old and the 35-year-old. The 25-year-old commits to $500 monthly contribution as they have much disposable income, while the 35-year-old commits to a $200 monthly contribution to each asset. After 20 years, the 25-year-old's assets will have grown by 7%, resulting in each of the investments being valued approximately at $265,321, adding up the total value of the 2 investments to over $530,642. As for the 35-year-old's assets growing by 7%, each of the investments will be valued approximately at $117,737, adding up the total value of the 2 investments to over $235,464, showcasing the remarkable potential of the 722 rule when applied to a diversified investment strategy with two different adult individuals. So, what about if, as a parent, you want to kickstart your child's investment portfolio as early as now? Then this rule is the best one to consider using. When it comes to investing for your child, the best two assets to offset with are setting up a 529 account for their education and a custodian Roth IRA for their retirement. You can also use other investment vehicles like index funds, ETFs, real estate investment trusts, or stocks. It all depends on you as a parent where you seem fit to invest for your child. The 529 account is specifically designed to help save for future education expenses, offering tax advantages and investment growth potential, and the custodian Roth IRA is a fantastic way to kickstart their retirement savings early on, thanks to its tax-free growth and withdrawal benefits down the line. To see how this rule will change your child's life, let's look at an example. For instance, you have a 5-year-old child and you decide to start investing in their education and retirement right away. First, let's consider the 529 account for education. You open a 529 account and contribute $1,000 annually for the next 20 years. Assuming a 7% annual return, we find that after 20 years of annual contributions totaling $20,000, at a 7% annual return, your 529 account would grow to over $46,000. That's double your initial investment, thanks to the power of compounding. Now let's turn our attention to the custodian Roth IRA for retirement. You open a custodian Roth IRA for your child and contribute $500 annually for the next 20 years. Again, assuming a 7% annual return, we find that after 20 years of annual contributions totaling $10,000, at a 7% annual return, your custodian Roth IRA would grow to over $23,000. Again, this doubles your initial investment. Something to note is that these compounding calculation results may differ when using the free available compounding calculators, but the final results are close to each other. Now, let's put it all together. After 20 years of consistent contributions to both the 529 account for education and the custodian Roth IRA for retirement, your total investment of $30,000 would grow to over $69,000. But we're not done yet. Remember, these calculations only take us to the 20-year mark. Assuming your child decides to continue contributing to both accounts over time, these investments could continue to grow and compound, setting them up for a financially secure future. Something to note is that these rules of compounding may not be for everyone, so find one that works for you. When it comes to the return on investment, ROI, the most realistic target is usually either 8% or 7% for most investment vehicles. As for the duration you want your investment to grow and compound, it will depend on how long you personally want your investments to grow without you withdrawing from them and letting the amounts reinvest and continue to compound. And when it comes to assets, again, you are the only one to decide how many you are willing and capable to invest in. As it said, personal finance is personal to you. So make sure before you commit to start to use either the 843 rule, the 722 rule, or any other rule of your choice to compound your investments, assess your risk tolerance and your long-term financial goals. Whether you're investing for yourself or your children, the 722 rule of compounding approach can help you build wealth and secure your financial future. Remember, it's never too late or too early to start investing, so why not take the first step today? Your future self will thank you for it. All right, here's the deal: doubling your money. Everyone wants it, but how do we actually get there? Today, we're diving into one of the simplest yet powerful formulas in personal finance: The Rule of 72. Whether you're looking to build wealth, retire comfortably, or even just feel financially secure, the Rule of 72 gives us a clear path forward. This formula makes understanding the growth of our money both straightforward and inspiring. So let's walk through how this rule works, how compound interest plays a role, and why it could be the game changer you've been searching for. Let's start at the top. The Rule of 72 is like a shortcut, a mental math trick that shows you how long it'll take for your investment to double given a specific interest rate. You divide the number 72 by the annual interest rate, and that answer tells you how many years it'll take for your money to double. For instance, with an interest rate of 6%, your money would double in about 12 years. And this works for any rate of return, making it versatile and practical. The beauty of this rule lies in its simplicity. No need for complex calculators or fancy financial models, just this one easy formula. The formula might look like a simple division, but there's a lot going on in the background. The number 72 isn't just a random pick. It's based on the magic of logarithms, which balance out as a great estimate for average growth rates. This formula works best with interest rates in the range of 5% to 12%, which is what most people can reasonably expect from long-term investments. So, if you're working with an 8% rate, you get 9 years of investment growth. That means every 9 years, your investment will double. Now imagine you're investing for 18 years. With an 8% return, you're not just doubling your money once, you're doubling it twice. If the Rule of 72 tells you when your money will double, compound interest tells you why it doubles. Compound interest is, essentially, interest on interest. Every time you earn interest, that interest gets added to your principal, and then you start earning interest on this new amount. This repeated cycle accelerates the growth of your money. Let's break it down. If you start with $1,000 and earn 5% in interest on a high-yield savings account, you'd make $50 in the first year. In the second year, you're not just earning 5% on that original $1,000, but on $1,050, which means you'll earn more. It keeps building, and the bigger your balance gets, the more interest you're earning, and that's the power of compounding. All right, so how can you use this rule to multiply your money? Let's look at a few scenarios. Let's say you're saving up for your kid's college fund. You've got $10,000 set aside in an account earning 6% interest. According to the Rule of 72, your money will double every 12 years. So in 12 years, your $10,000 becomes $20,000. And in another 12 years, that $20,000 turns into $40,000. Or maybe you're thinking about retirement. Say you invest $50,000 in an index fund averaging 8%. Following the Rule of 72, your money will double every 9 years. So after the first 9 years, you'd have $100,000. In 18 years, that becomes $200,000. And in 27 years, it will grow to over $400,000. All of this happens just by leaving your money invested and letting compounding work its magic. We've talked about returns, but let's get real about interest rates. This rule gives us a sense of how different interest rates impact our doubling time. For instance, at a 3% rate, it would take 24 years to double your money, but at 10%, it would only take about 7.2 years. That's a huge difference. Higher interest rates shorten your time to double, showing the advantage of finding investments with solid returns. So, when you start to understand this, you see the importance of even a small percentage increase. A 1% or 2% difference in your return might not sound like a lot, but over time, it's the difference between doubling every 8 years or every 12 years. With that in mind, you will need to find a high return rate investment. This might seem daunting, but there are options out there. Many look to stocks or funds that track indexes like the S&P 500, which has historically averaged about 10% annually, And with the rule of 72, that means a doubling time of roughly 7 years. Stocks come with risks, but when you play the long game, they can help you ride those growth waves. Or consider bonds or other safer options with lower risks, which might yield 4 to 5%, which will mean more years for your investments to double. While the doubling time is longer, 14, 18 years, it's still growth that compounds over time. The key is understanding what interest rates you're comfortable with based on your risk tolerance and goals. Of course, while we're aiming to double our money, we also need to watch out for inflation. Inflation is like compound interest, but working against us. It's the gradual decrease in purchasing power. If inflation is at 3%, then prices double every 24 years. This means the value of the doubled amount might not be as high as it seems in today's terms. That's why we look for interest rates that can outpace inflation. If your money is only growing at 2% while inflation is 3%, you're technically losing purchasing power each year. But with an investment returning 6%, you're not just doubling your money over time, you're also protecting its value. While the rule of 72 is incredibly useful, it's not perfect. It's an estimate, not a guarantee. Real-world returns vary, and investments come with risk. If the market goes through a rough patch or you face unexpected expenses, your journey to doubling could be delayed. Another pitfall? Taxes and fees. If you're earning 8% on paper but lose 2% to fees and taxes, your effective rate drops to 6%, which means a longer doubling time. So keep your eye on net returns, what you keep after fees, not just the gross return. Think about where you want to be in 10, 20, or 30 years. Every dollar you invest today has the power to double and double again. The rule of 72 isn't just a formula, it's a gateway to understanding how your money can grow. Each doubling of your investment brings you closer to financial freedom, and with each year, your patience pays off. So whether you're starting with $500 or $50,000, the journey is the same: consistent, long-term growth. Take the rule of 72, let it guide you, and know that with time, patience, and a solid interest rate, you're on a path to a more secure, wealthier future. And that's not just math, that's the power of compounding. Compounding is one of the strangest forces in life because, for the longest time, it feels like absolutely nothing is happening. You keep saving money, you keep reading books, you keep putting in hours at the gym, or you keep showing up to work with discipline, and yet, for months or even years, the results appear flat. That's why most people give up. They look at the short-term effort and compare it to the short-term results, and the math doesn't add up. It works quietly, almost invisibly, storing up momentum in the background, and only when time has passed does the growth curve bend upward in a way that looks like sudden success. But it was never sudden. It was hidden growth, accumulating quietly while you stayed consistent. This is why compounding feels almost unfair. At first, you're putting in 100% effort for what looks like 1% return. You're frustrated, tempted to quit, tempted to compare yourself with others who appear ahead. But compounding doesn't reveal itself to the impatient. Its rewards are reserved for those who keep watering the seed even when there is no visible sprout. Then, one day, without warning, the results begin to appear everywhere. Your investments multiply, your body transforms, your skills make you irreplaceable, or your reputation brings you opportunities. It looks like magic to everyone else, but to you, it's just the day compounding finally showed itself. And that's what this video is all about, revealing the subtle, low-key signs compounding is quietly working for your money, habits, skills, education, reputation, and relationships. 1. When effort feels easier than before. One of the first subtle signs that compounding is working in your life is that the effort that once felt like a grind now feels natural, automatic, even easy. At the beginning of any journey, every step feels heavy. Saving that first $100 requires saying no to a dozen temptations. Going for your first run feels like punishment. Opening a book when you'd rather scroll your phone feels like resistance training for your brain. But consistency rewires the brain. Habits form, discipline becomes routine, and what once drained your energy now requires little willpower at all. That's compounding at work, not in the bank yet, not in the mirror yet, but in the quiet rewiring of who you are. This is powerful because it means you're no longer burning energy to push yourself forward. Compounding has begun to shift your identity. You're no longer someone trying to save, you're a saver. You're no longer someone forcing yourself to read, you're a reader. You're no longer someone struggling to stay consistent, you're consistent. This identity shift is the first hidden dividend of compounding, and it's worth more than any number in your account. When effort feels easier than before, you've crossed the invisible barrier that most people never get past. The barrier where compounding begins to carry you instead of you carrying it. 2. Small wins. Start to stack without force. Another sign compounding is quietly working is that small wins begin to show up more often, even when you're not pushing as hard as before. At the start, everything feels like a battle. You fight for every inch of progress. But once compounding kicks in, you start noticing victories that come naturally. Your savings account grows even on days when you don't think about it because interest is doing its job. Your body holds strength even when you miss a workout or two because your foundation is stronger. Your skills stay sharp because you've built depth that doesn't fade overnight. Suddenly, the game feels tilted in your favor. This stacking effect is what separates compounding from ordinary effort. One good decision today multiplies into opportunities tomorrow, which create advantages the day after until you're living inside a snowball of momentum. You don't have to push the boulder uphill anymore. The hill is working with you. What most people don't realize is that compounding is less about the big wins and more about the accumulation of small, almost forgettable wins. $1 saved, a page read, a connection made, an hour invested individually, they look like nothing. But string them together over months and years, and you suddenly wake up to a life transformed. 3. Outsiders. Notice before you do. Perhaps the most underestimated sign that compounding is working is when other people start to notice before you even realize it yourself. A coworker asks how you always seem to know the answer in meetings. A friend tells you they can see you've lost weight. A family member remarks that you've become calmer, wiser, or more disciplined. From your perspective, it still feels like nothing is happening. You're too close to the process to see it. But outsiders, who see you in snapshots rather than daily detail, notice the shifts earlier. That's when you know compounding is finally breaking through the surface. This external recognition matters because it reflects the invisible work you've been doing behind closed doors. People will call you lucky, but what they're really seeing is the delayed harvest of seeds you planted long ago. They don't see the boring mornings, the sacrifices, or the times you doubted yourself. They only see the visible results that compounding has now made undeniable. The irony is that you'll often feel like nothing special. You're just doing what you've been doing for months or years. But that's the point. Compounding turns consistency into excellence so gradually that you don't notice until others point it out. And when they do, you'll realize that your silent effort has turned into visible results. 4. Your baseline standards. Quietly upgrade. What once felt like a milestone now feels ordinary. At the start of your journey, saving $1,000 felt monumental, but after years of consistent growth, $1,000 feels like a drop in the bucket. When you first started learning a skill, completing a small project gave you a rush of pride, but now you're handling larger, more complex challenges with ease. This is compounding in its purest form. It doesn't just give you more, it makes you expect more from yourself. This upgrade in standards happens so quietly that you often don't even notice it until you look back. You're not trying harder. You're just operating on a higher level without realizing it. Compounding has normalized growth. It's not that life got easier, it's that you became stronger, more capable, and more resourceful. This shift is powerful because it locks in your progress permanently. When your baseline standard is higher, you can never truly fall back to where you started. Even on your bad days, you're operating at a level that your past self would have considered incredible. That's when you know compounding isn't just working for you, it has redefined who you are. 5. Old mistakes become unthinkable. Another quiet sign of compounding is when the mistakes you used to make without hesitation now feel unthinkable. In the early days, you might have blown your paycheck on things you didn't need, skipped workouts without guilt, or avoided opportunities out of fear. But as compounding builds, those old patterns stop making sense. You've grown too much to tolerate them. Your awareness has expanded, your knowledge has deepened, and your self-respect has increased. What once seemed normal now feels reckless. This change is profound because it shows that compounding isn't just about gains, it's also about protecting yourself from losses. Avoiding mistakes is a form of compounding most people overlook. Every time you say no to a destructive habit, you're keeping your momentum intact. Every time you sidestep a trap you once fell into, you're preserving the progress you've already made. Over time, the absence of those mistakes compounds into stability, freedom, and growth. It's not flashy, but it's one of the strongest signs that compounding has shifted your mindset. You no longer sabotage yourself because you've simply outgrown the version of you that used to. 6. Interest works harder than you do. Perhaps the most rewarding moment in compounding is when the interest, whether financial, social, or intellectual, starts working harder than you do. In money, this looks like your investments generating more in a year than your own labor could. In relationships, this looks like your reputation opening doors before you even knock. In knowledge, this looks like your accumulated skills allowing you to learn new ones faster. It's the moment when the snowball is rolling downhill and growing on its own, powered not by your daily struggle but by the momentum you've already built. This stage changes your relationship with effort. You're no longer trading time for progress. You've reached a point where systems, habits, and accumulated value are working in the background even when you rest. That's why wealthy people seem to get wealthier with less effort, or why highly skilled professionals keep rising in their careers. It's not luck, it's compounding interest doing the heavy lifting. When you reach this point, discipline is still necessary, but it feels different. Your role shifts from pushing the boulder uphill to guiding the avalanche that's already in motion. 7. Opportunities appear out of nowhere. One of the most exciting but misunderstood signs of compounding is when opportunities start showing up as if from thin air. You get invited to collaborate, someone offers you a job without you applying, or people seek out your expertise. To outsiders, it looks like luck, but in truth, it's the delayed reward of compounding. The hours you spent building skills, the years you invested in your reputation, and the consistency you showed in your work, all of it created a network of invisible leverage. Compounding has been quietly building your credibility, and now it's cashing out in the form of unexpected doors opening. This stage is important to recognize because it can feel surreal. You'll wonder why people are suddenly noticing you, why opportunities are flowing to you, and why momentum feels so strong. But it's not sudden, it's the compound effect finally becoming visible. The truth is, opportunities don't appear out of nowhere. They appear because compounding made you ready to receive them. And when you're ready, the world notices. That's why most so-called overnight successes were years in the making. If opportunities are knocking without you chasing them, it's proof that compounding has matured, and now it's paying you in ways that go beyond numbers. 8. The gap between you and others quietly widens. Compounding doesn't just move you forward, it slowly pulls you away from everyone who isn't compounding. At first, the difference between you and others is barely noticeable. You save a little, they spend a little. You read a book, they binge a show. You go for a jog, they skip it. Day by day, the gap looks invisible. But as the months roll into years, something dramatic happens. The small choices you made consistently have multiplied, while their choices have stagnated or eroded. The difference is no longer subtle, it's life-changing. You've built momentum, skills, and assets while they've stayed in the same place or even slid backward. What makes this stage powerful is how quiet it feels. There's no trumpet announcing your progress, no scoreboard showing the widening gap. It's only visible when you look back years later, or when others suddenly realize you've moved far ahead. They'll say you got lucky, that you must have had some secret advantage, but the truth is that you just stuck with compounding while they quit. This widening gap is both a reward and a responsibility. It proves that compounding is real, but it also means you're no longer in the same game as everyone else. You're operating at a level that only long-term thinkers ever reach. 9. You're playing a different game without realizing it. In the beginning, you were focused on survival, making ends meet, learning the basics, doing whatever it took to stay afloat. But over time, compounding elevates you from survival to strategy. You're no longer worried about scraping by. You're thinking in decades, not days. You're no longer reacting to life, you're designing it. This shift happens so gradually that you often don't realize you've crossed into a new league. Your decisions carry exponential weight now. While others are stuck debating whether to save $100 or spend it on something flashy, you're asking how to multiply $100,000 into $1 million. While others panic at setbacks, you view them as temporary dips in a long-term upward curve. This is what separates compounders from everyone else. The game has changed. You're not chasing quick wins or shortcuts anymore. You're operating with patience, leverage, and foresight. And that's the quiet power of compounding. It moves you from the ordinary game to the exponential one. 10. When compounding outlives you. At legacy stage of compounding, the seeds you planted continue to bear fruit for others long after you've stopped actively tending them. In money, this shows up as generational wealth, investments and assets that provide for your children and grandchildren. In knowledge, it shows up in the people you've taught or mentored who now carry your lessons forward. In character, it shows up in the reputation and trust you've built, which continues to open doors for those connected to you. Compounding has transcended your personal timeline and become something bigger than yourself. This stage is the ultimate proof of compounding because it demonstrates that time is the most powerful multiplier of all. Your consistency, your habits, and your long-term thinking ripple outward into the lives of others. The book you wrote keeps inspiring. The business you built keeps employing. The wealth you grew keeps funding opportunities. Even after you're gone, compounding continues. That's when you realize the true purpose of compounding. It's not just to enrich your life, but to create a legacy that impacts others in ways you may never even see. The hardest part of compounding is the beginning, the silent years when you feel like you're putting in endless effort for microscopic results. The truth is, compounding always works. It just doesn't announce itself early. It hides, it tests your patience, and it rewards only those who stay consistent long enough for the curve to bend upward. That's why patience is the price of admission. If you want the freedom, wealth, health, and legacy that compounding can deliver, you must be willing to endure the seasons when progress is invisible. Because when compounding finally reveals itself, it doesn't just give back what you put in, it multiplies it in ways that look impossible to everyone who quit too soon.